This material is made available to you by or on behalf of the University of Melbourne under Section 113P of the Copyright Act 1968. It may be subject to copyright. For more information, visit the University Copyright website.
Just waiting for the record light to come on. Oh, it is on. Oh, okay, we're away. Very good. Blow the whistle. Okay. All right. Well, hi everybody. How are we all? Hope you're going well. Gee, our numbers are a little bit paltry this week, aren't they? Yeah, with assignments, yes. Oh, well, thank you for making the effort. Thank you for coming. We do appreciate it. And hopefully I'll give you some things tonight you can take away that might help you with your assignment, perhaps even, and might even go beyond that. All right, so where we're at the moment is that we started talking about the Week 7 materials last week. I want to continue that discussion and then use some of the things that we talked about in the Week 7 materials are fundamental things that go to the core of how you analyse and think about things in a market risk context. But also they go beyond that because they can also apply into some of the other areas as well, but nonetheless the most fundamental place where you'll see them applied is obviously in that area. Now, you might remember last week we talked about the idea of an economic clock or an exposure clock. And when we talked about that, we talked about the idea that you, in business, will have a range of different exposures. You know that those exposures are going to be oftentimes in the future. You can't see the future. At best, you can try and approximate what you think the future looks like. You can do that from history, or alternatively, you can go and see what is available within the market. Of course, the other alternative is you can build your own model and think that you can outperform the market using your own model if you wish to. Now, where we got to last week, of course, we were talking about, well, what happens when, of course, we have these exposures. We have someone that has an exposure to downward price, someone has an exposure to upward price. And what we saw was that, of course, when we actually engage in hedging, what we are actually trying to do is we're trying to, of course, minimise the risk exposure associated with those downsides. Now, that's a pretty fundamental concept at the end of the day when you think about it. We're trying to minimise the risk associated with, obviously, those exposures. But what happens, of course, is that we still have to make decisions about how we are going to hedge, what it is that we're going to hedge with, in the sense of the process by which we'll do the hedging. And then, of course, as we know that we've got a risk management process that we've got to follow, and under the risk management process, there's a requirement there that obviously we've got to go through it step by step to make sure that we've covered all the bases. We can't just simply race to the end. We can't just simply go, oh, I know, for the last 40 years we've always used an 80% hedge ratio, so therefore we'll just apply that again now because that will cover us for the current period. I mean, obviously there you're being anchored, and obviously the anchoring is actually creating a potential problem that if in fact a better, more modern hedge ratio, maybe at 95% or even at 60%, might actually give an improved performance. So you find that corporate treasurers constantly have to go through this process of reviewing and rethinking about how they will do their hedging, looking for alternatives. I mean, if I reflect back, obviously I've been around for a little while, but if I reflect back on the 1980s, for example, in business, a lot of people didn't even sort of have the concept of actually using things like options or other type of products that we have now, because those sort of products just didn't exist, or they did exist, but they were so basically esoteric that people thought, oh, I'm not going to touch that. Boards would never go near an option because it was, why would you pay money for something that you might or might not use in the future? So they never really understood, if you like, some of the characteristics of how they could use these instruments. Even for that matter, using something like, for example, an interest rate swap, right, where you can try and look at your volatility of your floating cash flows for interest rates, and you can hedge those by obviously flattening them out with a fixed rate under an interest rate swap. I mean, swap instruments commercially offered by banks didn't happen until the late 1980s, early 90s. So again, these were not instruments that were basically readily around. Now, I'm not here to teach you about what happened in the 80s. I'm here to tell you, obviously, what's happening in the future. But I use that as an example of the fact that, obviously, as you know, markets change. And who knows, 10 years, 20 years from now, what instruments will actually be used then to actually do hedging, and how those instruments in themselves might actually behave. So again, we have to be careful we don't become just anchored to using one particular approach and then always use that at a set ratio or whatever on the way through. The other thing that becomes important when we think about our exposures as well is that if I need to conduct a spot transaction today, the spot market is exactly that. It is the spot market. It is the market that the prices are at as at today. So when I trade spot, I don't have any exposure, right? I don't have an exposure at spot price. Why? Because obviously that's the price, okay? However, the moment the price actually evolves forward, in other words, the moment the spot price starts to move forward in time, right? So spot price today, spot price tomorrow, spot price the day after that, etc., yes, then the spot price starts to obviously give me an exposure. And then, of course, we eventually get to the point where at some point in the future, we want to know, well, 3 months from today, 6 months, 12 months, whatever it is, what will be the price on that future day? And if I can get a sense of what that price will be, I can then start to make decisions about what type of hedging or what type of activities I'm likely to undertake. Now, just because the market itself might quote a price, so for example, the market might price currently spot at, let's say, $14.50 per ounce, and it might quote spot gold at, let's say, in 3 months' time or 6 months' time, let's say, it might quote at, say, $14.75. So there's a $25 premium between now and in the future. Now, just because that price is $14.75 in the forward market does not in itself mean that when we get to that actual forward date, that that's what the spot price on that day will be. The price could well be different from what that agreed price is. And this is where sometimes firms get themselves into some liquidity problems because they enter into forward contracts or into contracts that require them to do cash settlements. And sometimes those cash settlements might require you to put up collateral. You might have to add to your collateral over time if the price moves against you. Okay? So for example, if you trade the futures contract, or for these days, in fact, if you trade a forward contract, you've got to actually put up collateral as part of your trading for those forward contracts. And if the market was to suddenly move against you, you would find that you would actually have to be paying money into your collateral account to actually be able to manage the fact that when you get to the end of that life of that contract, that there will actually be money available to settle the contract at that future point in time. So therefore, whilst we can use market prices, trader prices, or trade-ed prices if you like, as an indicator, they in themselves do not in fact mean that that is what the price is in the future. Right? Now, I guess where I'm trying to go with this is, if I stood here today, I can form an expectation of what I think the price will be in the future. I can observe today's spot price, I can observe forward prices, obviously the market traded forward prices, and I can actually form an expectation of what the spot price will be in the future, the expected spot price. So there's got to be a relationship that exists between those three prices. If there was no relationship between those three prices, then of course, basically, trading forward would be a nightmare. How would a trader know where to place what he thinks the actual value will actually be? Keeping in mind that what the traders are interested in doing, the banks, they're interested in not only obviously meeting your needs in terms of giving you a forward contract to buy or sell, but they also are looking constantly for anomalies in prices. They're looking for where the prices don't reflect the fundamentals or what the prices should actually be. And what that means is, of course, that the banks themselves will often try to look out for what are called arbitrage windows or arbitrage the market. Now, the arbitraging of markets, of course, well, that's probably beyond the scope of this course, because a lot of corporates don't get involved in arbitrage, right? Not from the point of view of if you're trying to manage your risk in your market risk portfolio, you don't sit there all day waiting for an arbitrage window to simply try and pick up a couple of basis points or a couple of pips on the exchange rate, okay? Whereas there will be traders, arbitrage traders, that will actually work within the banks, and that's what they are doing. They're electronically scanning all the markets, looking for where there are opportunities that they can basically pick up and make money at any point in time. So what happens is that we need, therefore, to explore this relationship between spot, expected spot, and forward prices. So to do this, well, let's firstly, as we normally would do with these things, let's try and put some definitions around this. And we've already tried to do that in the sense that spot trades involve transactions for immediate exchange. And then, of course, a forward trade, well, that involves some unconditional transaction that's going to happen in the future. Now, it could be that we actually negotiate a price, and that price becomes a forward price. Alternatively, we might just agree that we will actually exchange goods, right? For basically, you know, we'll come into an arrangement where I'll exchange goods with you, but then we won't actually nominate the price. We'll review that when we get closer to the time. Well, if you did that, A, you'd probably be silly for doing it, but B, if you did it, obviously, right, you do leave yourself very exposed to, because what we know is that when we go forward a few seconds, the world's changed, the information's changed, the markets have moved. And therefore, the spot price has moved, and also people's perceptions of what the forward price is likely to be have also moved. So let's assume we had three series of data, three data series. Data 1, data 2, data 3. So look firstly at data 1. We've got 3 time points from A, B and C. We've got on the vertical axis, we've got of course the price, and on the horizontal axis we've got time. So as at today, we can observe a spot price, and that becomes our beginning point, a spot price. Notice how with the spot price, I've just drawn a line across the page, right, as to where the level of the spot price actually is. Even though that spot price doesn't apply at all these future times, the spot price, I've just put it in there so we know where we are relative to that original spot. If you look at the first series, you see the first series obviously is a series where future prices seem to be higher, forward prices seem to be higher than where current spot prices actually are. Forward prices are higher than current spot prices. Under those circumstances, what that means is, of course, that if you were to transact for delivery or for purchase at that point there, that's where the price would be. If you were to go at point B, right, then that would be the price, and then if you went to C, that's where the price would be. Now, what you should be able to see there, of course, is what we're saying is that these forward prices actually have their own term structure. In the same way that when we talk about interest rates, we talk about interest rates having a term structure of interest rates, forward prices in markets also have their own term structure as well. And that forward structure, of course, that forward term structure is driven off the back of fundamental things related to the relationship that exists between the spot and the forward price. So then we have another series, this one here, that in the future, geez, a bit of a dog, this one, the price looks like it's going to fall, all right? Now, if we think the price is going to fall in the future, all right, well, of course, so I'll go back to the first series just for a second. If I had looked at the markets and I saw that markets were rising, if I was a company that was exposed to price increase, then chances are I'm probably going to think about hedging. If I'm a company that's exposed to price decrease, and the forward market is telling me that obviously, you know, their future price is going to be upwards, then I might go, well, yeah, I've got a hedge, but maybe I'll hedge 50% or 60 or 70%. I won't hedge the whole lot. I won't hedge everything, all right? Because to hedge everything, of course, puts us into a situation where, of course, I've now, once I do hedge, if I fully hedge 100%, I've locked in my forward contract at that price. And by doing that, of course, there's a problem, because whilst this might be how we think the prices will evolve, right, the prices themselves could evolve like this. They could go like A, they could be even higher than A, or alternatively, they could even go like Series B or C, or 2 or 3. So as a result, that means that, of course, when we decide as to how we are going to hedge, and the vehicle or the instrument through which we'll do the hedging, we have to be aware of some expectation of where we think prices are going to evolve to in the future. If we go down to Series 3 for a moment, Series 3 is obviously something that to some degree mirrors 1, but nonetheless obviously shows the fact that we've got a price series that is constantly falling, okay? Now, under these circumstances, of course, if I was a company that was exposed to price decrease, then again, I would be very concerned about the fact that the market thinks these prices are going to fall. What can I do to try and protect myself that they don't actually fall even further than where these prices are actually going to? So again, obviously that would then become a decision about what quantum I would hedge, and obviously as to whether or not I was happy with the price that was available. But then you have a look at a series like Series 2. Right? Series 2, a bit odd, isn't it? Up, down, up, down. Now, you could get ones that are quite seasonal, right? Seasonal prices, especially for commodities, especially for soft commodities. For example, things that are produced by agricultural means and so forth, you often get seasonal pricing. And therefore, because you get that seasonal pricing, and you can get seasonal pricing on some of the oils and things like that as well, because obviously whether it's winter in the Northern Hemisphere or summer in the Northern Hemisphere affects things like oil consumption and heating oil and other things. So as a result, you can actually get periods of time where, of course, the forward price could be high, and then other times, might be in the middle of summer, the price might actually be quite low. And so therefore, we can't just generalise. We can't just go, on average the price is at X, right? Because that's obviously not fair to the evolution of how the prices actually behave. Now, what happens here is that we actually have in finance, and in economics for that matter, we have names for each of these different types of series. The Series 1 is what is called a contango, right? C-O-N-T-A-N-G-O, right? A contango. And under a contango, what happens is that there is an expectation that the forward price will be higher than today's spot price. So in other words, at points A, B and C, Series 1 is always in contango. When you have the opposite of that occur, when you have, obviously, like Series 3, where it's all downwards relative to the spot price, that is referred to as backwardation, right? Backwardation, right? So, and on the next slide, you'll see these, right? Like I've got them already set up for you on the next slide, right? So forward price, obviously, greater than the spot price, that's contango. When, obviously, forward price is less than the spot price, obviously, forward price for delivery at time T, you're observing the forward price as at time 0 today, the same time that you're observing the value of what the spot price is. Under those circumstances, that will be, obviously, what we call a backwardation. Now, what happens is, of course, that whilst forward prices from banks and other parties are things that obviously we can look at and then use that for information about where we think prices are going to evolve to, we still need to satisfy ourselves as a treasurer that we think those prices are realistic. That we're not just looking at a big price bubble that might burst between now and that future point in time. Okay? So in other words, we've got to do some of our own analysis to actually get comfortable that the forward price that's actually out there is fairly reasonable. So if it turns out that we did that, well, to do our own analysis might mean that we might actually project forward and try and work out what we think for ourselves the expected spot price will be at times A, B and C in that prior graph. So we try to work out what we think the expected spot price will be. Now, we could use things like, and you've done investments, we could do things like fundamental analysis, right? We could build a model and try and project forward as to what we think the price will actually be. Alternatively, we could obviously use technical analysis where we could look at all the patterns and say, projecting on the patterns as to where we think the price will actually be. But nonetheless, we form a view that we believe that obviously we can predict as to where we think the expected spot price will actually be. Now, that expected spot price has a relationship to obviously the forward price. Okay, the expected spot price has a relationship to the forward price. It almost goes to how good a forecast it actually is in some respects. Okay, so if we were to form a view as to what we thought the price was going to be, and if we did that, we would be, and let's say we observed that the forward price was greater than the expected spot price. The forward price is greater than the expected spot price. Okay, so go back here. Okay, I know the prices are going up. The forward price is here, but I've done an analysis and I think the forward price is probably more likely to end up about here. Okay, what will happen will be that that market will be deemed to be in what is called a normal contango. So it's still using the word contango because there's an upward movement in the forward price, but obviously now what's happening is that the price that you're expecting the outcome to be is actually lower than what the contango forward price implied actually is. Now, if that was to be the case, and that was your view, you might then change your mind about whether or not you actually want to hedge using this price up here. Depends again as to whether or not you are exposed to price increase or price decrease. Price decrease, you'd say, well, all our models are telling us that the price is only going to reach 15.45. The market's trading at 15.75. We're not happy about that. Therefore, we might only hedge 50%, 60% within what our policy guidelines tell us we're allowed to hedge. And then what happens is, of course, we have to consider the alternative. What would have happened if, instead of the expected spot price actually being higher than what the actual contango forward price actually is? So in other words, if the spot price, right, our expected spot price, evolved such, expected spot price evolved such that, boom, it ended up here. So we've done an analysis. The market's telling us the forward prices are going to be at 14.75. We think they're wrong. We think the price could go as high as 15.50, right, or 15.500. And so therefore, obviously, we're going to do something about that, right? 15.500 doesn't make sense. Goes to 1,600, right? We would then say, under those circumstances, our expected spot price is above where the forward price actually is. And under those circumstances, we have a thing called normal backwardation, right? Now, if you go into Google and go, right, into Google, Professor Google, right, and you just type in backwardation, be careful, because some people call, mistakenly, they call normal backwardation. They're not the same thing, right? Backwardation is about the relationship between the spot and the forward price. Normal backwardation is about the relationship between the expected spot price and the forward price. Okay? Now, as we start to compare, what we find, of course, is that if I was looking at Series 3, in Series 3, even though the price is going downwards, if the actual expected price was lower than where the forward price was at points 1, 2 and 3, that market would be in a normal contango. If the price was above, right, because even here we had it above, obviously, or below. So whether it's above or below where the forward price actually is will determine as to how this outcome will come about. So it's worthwhile to just spend a little bit of time and just get your head around this, because what often happens is that people tend to talk in markets, especially in commodity markets. They talk about markets being at a premium or a discount, but they often also talk about the market being in a contango period or a backwardation period or whatever it might be. And so therefore these terms do sometimes get used interchangeably in the markets as well. Now, it's one thing for me to stand here and go, but there's these relationships, but if you are the corporate treasurer and you've got to try and come up with some sense of what this expected spot price is going to be, how on earth are you going to do it? Well, it actually turns out that, of course, there are relationships, there are theoretical relationships. If the market was basically perfect competition, lots of players in the market, right? Lots of people participating, lots of quality information that everyone can share at the same time. We've got no private information that people can trade on. Okay? Then what will happen will be that there will be a theoretical relationship such that the forward price will be equal to the expected spot price, always. Because we don't live in a world with perfect competition, perfect information sharing, right, etc., etc. As a result, those asymmetries, if you like, create differences. Now, what we need to do, though, as a corporate treasurer is we still need to come up with some view as to what we think this expected spot price is going to be. Now, as I said earlier, we could take the cop out. We could simply go ahead and say, well, look, we'll just look where the forward market is, the forward points, whether it's foreign exchange, commodities, whatever it might be, and we'll just say that, well, the expected spot equals the forward, therefore we put feet up and put the hands behind the head for the rest of the day and go down and have a coffee. All right, alternatively, we could actually get serious about this and we can say, well, there must be some relationship here. And the relationship is one that is actually built around what is called the theory of storage. And what happens is this, that For example, if I had a commodity and I wanted to know what is going to be the price of this commodity in the future, okay? Well, if I have a commodity today, I've got to store that commodity so I can sell it in the future. So if I have to store it today, there must be some costs associated with storage between now and this future point in time. But of course, if I didn't own the goods today, but I wanted to sell them in the future, then that would mean that I need to be thinking about the fact that when I do go to sell them, that the future value, if you like, obviously I'm probably going to have to borrow money today to buy the goods, stick them in storage today, right? Buy the goods today, but to do that I borrow money today, and then I stick them in storage, which means I'm paying for both the spot price and also the storage price. I then hold that to the future date, and if you do that, well, that's easy. Well, because that's just the spot price plus the storage price multiplied by 1 plus r to the power of t. Ooh, number of periods. Okay, so I haven't told you about this one, I haven't told you about this one yet, have I? Can you still see them? Hope not. Okay, so, right, so there you go. So we've got now the idea that I buy the goods today, I put them into storage, I borrow money to buy them into the storage, and obviously that costs me some interest rate, and obviously this borrowing will be over a period of time t. There's a certain common sense to this as well when you think about it, because of course the forward price, right, the discounted value of the forward price should actually be able to be replicated using that same thinking, shouldn't it? Right? So obviously for this arbitrage relationship to hold, you've got to be able to look at the forward price and back it back to where the spot price is by taking these things out. Now, there's two other parameters in here though that are a little bit, okay? Let's think about what they are. Okay, well the first of them, I won't do Y, I'll park Y. Let's do Q first. Let's assume that I want to have gold available 3 months from today. So what I can do is I can go to the Perth Mint, the Melbourne Mint, just down the road on Latrobe Street, and I can buy gold today. And I can put that gold into storage at the Mint. Okay, very good. Now, it's going to sit there for 3 months, 6 months, 12 months, whatever the period is that obviously I'm trying to look into the future for. And that's fine. Right, I'm happy for it. It's just secure there. It's not like I'm carrying the gold bars around in my pocket all day and go out at night time to the clubs and, you know, oops, I've lost one of my gold bars at the club and, you know, hope they find it for me, whatever else, okay? So, what happens here is that we end up, obviously, with these gold bars safely secured. But here's the thing. Whilst they're actually sitting in storage, guess what I can do with them? I can lease them to somebody else. How can you do that? Well, what I can do is I can actually lease the gold to a third party that needs gold as collateral or as security for transactions that they are undertaking. And so by me actually leasing the gold to someone else means that I actually get a cash inflow to the value of obviously what the rate is that I'm charging to lease the gold. So what that means is that when I'm working out, well, I borrowed this money to put this thing in storage and obviously to pay for the spot and pay for the storage, but what I can do is I can take off the value of the leasing. Okay? And you might think, well, who leases gold? Well, there's a lot of parties out there that will lease gold. Like people that are gold traders will lease gold. Right? They'll lease gold because what they do is they don't actually need the physical gold sitting in gold bars on their desk while they're trading. They just need access to gold. So in other words, I could actually, for example, I could lease gold from you, I could trade, and then after I've made my profits and so forth, in the window I had for leasing, I'd just give you back the gold bars at the end of it. But I never physically have the gold bars. They're still sitting in the mint. It's just the title to them transfers to me during the period of obviously whilst I'm holding them as a lease, which then means I can use them as collateral for any gold-based transactions that I'm actually doing. So if I'm a gold miner, or if I'm a company that purchases gold from a gold miner, like jewellery companies and things like that, I can actually do these types of transactions. And there are lots of brokers and other traders out there that just trade gold. And this is how they do it. This is how they get the rights to say, well, I've got all this gold. I don't actually own the gold. Someone else owns it. I'm just leasing it, but I've got the rights to use it for the time being. Think about it in this way. What happens if you did a repo, right, a repurchase agreement? What would happen if you short sold an asset? Right, if you're going to do short selling in the equity market, you've still got to actually get the actual equity from someone else, right? And then you pay a premium, don't you? You pay for the rent of obviously whatever it is that you've actually rented from them to actually do the actual transaction. Now, it doesn't mean you won't lose money, but of course, hopefully you won't if you're doing it good enough. So, this Q, think of it as actually being a cash inflow that you get from holding the asset. A cash inflow. Let me give you another example of one. Let's assume that I'm looking to price a bond, and the bond has got coupons. Well, the coupons are actually cash inflows. They are cash inflows that happen during the life of the bond. So when we price a bond, we don't price the bond just as simply being the base value we get back at maturity. We include into the price of the bond, don't we, the actual value of the coupons that we get during the life of the bond. So effectively, the coupons become like the Q that is actually in this calculation here. Although, albeit I don't think bond pricing formula doesn't look like that, right, but it's the same principle that's actually occurring. So if I was to lease my friend here in the front row, if I leased him a bond, right, or if he was going to short sell a bond and I gave him that bond for a fee, what will happen will be that if during the period whilst he is holding that bond there was to be a coupon payment, the rights to that coupon would flow to him, not to me. Alright? So therefore the price would need to adjust for obviously the fact that there has been obviously a drop off of a coupon during the time period. Alternatively, we've still got one last parameter we need to think about. My goodness. So we've got the spot price, the actual cost or the charge if you like for storage. We've got 1 plus the borrowing rate minus obviously any disbursements that you can get out of the life of the actual instrument that you're holding in there. So this Y thing, my goodness. What's something that's really like, that's terrible, shouldn't do that. What's something that's really like popular right now? Give me something that's really super popular right now. Copy of the exam paper for FNC 90046. Okay, so what's popular right now? Oh, guys, surely something in your life's popular. Right? Here we go. Think of your favourite pop star, whoever that might be. Your rapper. Who knows, right? Might be Tom Jones. I don't know. Right? Cilla Black, perhaps. I don't know. All right, so think of your favourite pop star for a moment. Now imagine they're coming out to Australia. They are your favourite, my favourite, my favourite. And therefore you want to go and see them. You want to go and see them. You go to buy the tickets, and what happens? There's no tickets available. Right? So what do you then do because there are no tickets available? You go, oh well, couldn't get a ticket, let's go home. Right? Or some people might engage in trying to still get a ticket. You contact some of your friends and see if they've got tickets. You contact other people. You might go through the second-hand market, let's say, right, and try and purchase the actual tickets through the resale process. Now, apart from the fact that the government's put some laws around how much you can resell for, right, obviously if something is really, really popular and everyone knows that, what's going to happen to the resale price on those tickets? They're going to go up, aren't they? All right? Alternatively, if the person was an absolute dud, if you were the only person in Australia that actually liked the person, right, then obviously there'd be lots of tickets left over, there'd be lots of surplus, wouldn't there? All right? So therefore, what does the manager of the venue do to get more bums on seats, to get more people to come and sit and watch the show? What do they do to the price? They discount it, don't they? All right? So what we've got is two different scenarios. One where there are high levels of demand for something, right? But there is limited availability. And the other is where you've got a surplus of something, but obviously very little in terms of what the actual amount is. So what happens is this, that if you think about those tickets as being inventory, like in other words, the fact you go to the supermarket, you want to buy your favourite cereal, the cereal's not available, therefore you've got to choose something else, you walk out a bit disappointed, right? Well, that behavioural thing that you feel, that disappointment that you feel, is captured in this model, and is captured by what is called the convenience yield. The convenience yield. If they have your ticket and it is available, if they have your Cocoa Pops and they are available, if they have your Fruit Loops or your cornflakes or whatever it is that you like for breakfast and it is available, right, then you'll look at that and go, well, I can buy that, that's available, that's good, I feel good about that, right? So therefore, obviously there is a supply available at the time when people actually want it. So the effect on that would be that because there is a supply at the time when people want it, that would mean that the price, how you perceive the price, might actually be a little bit lower than if it was simply just basically the spot price plus the cost of storage. You might actually take off a little bit on the price because of the convenience of the fact that you can get access to whatever the actual thing is. However, if it turned out, of course, that there wasn't any popcorn or any Cocoa Pops or whatever else available, then what would happen would be that you would want to charge a really big premium and you would feel really bad about it. And in feeling really bad about it, that would mean that you would expect that the market should actually be taking this into account in terms of where the price will actually be. So one of the things that can happen is that the convenience yield can be either a positive thing, positive to you, in which case it will decrease what the expected price will be, or it could be a negative thing to you, in which case it will flip it, it will invert it, and it will make the price go up even higher. So scarcity will increase the price, but it is scarcity in the eye of the person who is actually doing the buying. So therefore, right, this means that, of course, if you were to actually have a situation like we just talked about with tickets, the tickets were not available, right, you would be prepared to pay a higher price. So the convenience yield is obviously the disappointment that you couldn't get the tickets at the price you wanted, but now you're willing to pay a premium over and above to obviously get those particular tickets, okay? This is the reason why when you get visiting artists come to Australia, they set up 1 or 2 shows, and then the moment that obviously those shows start to fill up, what do? Well, oftentimes they'll do a 3rd show, or a 4th show, or a 5th show. If they're picked, they'll do 75 shows, right? So it just depends on who the artist actually is, right, and how much time they've got available at the time when they're actually touring. Some artists might only come and do one night. There was a boy band here, a Chinese boy band that was here in Melbourne, I think on Friday night, right? And they're only here for one night, that's it, come on the one night. And apparently those tickets were being scalped for all sorts of weird and high prices. Obviously the popularity of a Chinese boy band. Go figure. Okay, so what have I also given you here? I've given you 2 formulas, haven't I? Which formula do I use? I'm all confused. Really easy. One of them is a formula that you would use if everything is expressed in discrete time. The other is a formula that you use if everything is expressed in continuous time. So in other words, if I was to say to you that the interest rate, right, is continuously compounded, the charge is a percentage that is continuously compounded, the actual benefit you get back is obviously from the actual holding of the physical asset is continuously compounded, and if the actual other thing here, the actual convenience yield, is also continuously compounded, you just use an exponential formula like that to work out what you think the forward price will be. Now, again, theoretically, right, those 2 formulas should give you the same answer, theoretically, right? And why is that? Because obviously we can always convert a discrete calculation into a continuously compounded calculation, right? So if I've got something that is already continuously compounded, I can actually convert that into an equivalent discrete compounding amount. Now, nobody's going to sit there with their calculator and do this in business, because you're going to have machines that do this for you and computer programs that will set up to do all this sort of stuff, right? The question really becomes for you, as obviously a person involved in looking at these things, is, well, what inputs do I actually use? What inputs do I load in for each of these different things, obviously, to come up with what I think the expected value will actually be? Now, as I said earlier, you calculate the expected value, you then look at where your expected value is relative to where the market is. Right? Where the market is telling you that they're willing to trade. And then you make your decisions based on that relativity. Hopefully, if your model is good and it mirrors what the banks are doing, you'll be very, very close to where the bank figures probably are anyway. But it doesn't mean you will be, because remember, one thing you've got to always remember with banks is, right, banks have a bid offer spread. You don't. Okay? And you'll pay the bid offer spread whichever way the side of the spread that you're on at a point in time. And so therefore you might come up with a price. The bank will never come up with exactly your price, because if anything, your price should be very close to their midpoint between their bid offer spread. Okay. So I've got some little exercises for you to do in the actual work and so forth for these, so you'll be able to do those. Now, hedging. My goodness. Okay. Hedging. So, we know that when you go through a risk management process, you start off by obviously understanding the environment within which your firm operates, and obviously what are all the risks, and you try to actually work out what categories your risks are and what the nature of your risks are and so forth. You then try and assess your risk by identifying, obviously analysing and evaluating your risks under, whether it's under a risk control or a risk optimisation or both sort of framework. And then what you do is you eventually have to come to a landing about a hedging strategy. Now, let's be very clear about this. Hedging does not automatically mean that you hedge 100% of your exposure. In fact, most hedging is actually done below 100%. Right? Most hedging is actually done below 100%. And a lot of that is because you often get timing differences that come up between the physical attribute you're trying to hedge versus obviously a locked-in date that you have if you enter into a hedge contract. So if I, for example, enter into a hedge to buy gold in the forward market on a particular day, right, it could be that when I go to buy that gold on that day, that there could be a problem associated with the sale of gold on that particular day. And therefore my counterparty may or may not be able to deliver. They might ring me up a week before the buy contract is ready to go and say, can you take it today and we'll give you a discount if you take it today. They might ring you up and say, oh, we've been delayed in getting the gold, we won't be able to deliver it to you until a week later. So you'll often find that you need that little bit of flexibility, right, in terms of the contracts that you're actually using. The other element is that sometimes your policy, by virtue of the board's own risk aversion, will state that certain types of exposures must be automatically 100% hedged. So if you have an exposure, let's say foreign exchange exposure or a commodity price exposure, or you have an interest rate exposure for a major borrowing that you're actually doing, right? I'm going to market and I'm going to borrow $100 million at LIBOR plus 50 basis points. Well, at that point, right, I know I've got an exposure to LIBOR, but it's LIBOR against $100 million. Therefore, I am worried if obviously LIBOR moves around. If LIBOR changes and goes up, I'm going to be fully exposed to whatever that exchange rate change will be. As a result, boards are probably likely to say under those circumstances that they'll want you to hedge 100% of the exposure. Why is that? Because you know that, of course, if I lock myself into, let's say, a 3-year, $100 million borrowing, I know exactly when the payments are due. I know exactly how those payments will be calculated in terms of benchmarking to LIBOR plus 50 basis points. And so suddenly I can actually start to go, well, I know exactly the timing, and I also know basically what the quantum is, because I'm always told a quarter in advance as to what the price will be that I have to settle at the end of that particular period. Right? So the normal process would be that you look at the price today, and that price becomes the price that will then apply, obviously, at that future point in time. And why is that? Because obviously if I'm trading interest rates, the interest rate has to reflect the holding period over which obviously the element actually does run. So risk, right, and I've put it in nice big letters down the bottom here, so risk hedging is all about trying to minimise your risk. Please don't tell me it's about eliminating risk, because it's certainly not that. But also what we know is that when we come to hedge, that hedging in itself obviously is designed in such a way that we want to get rid of unwanted financial risk. We know we can't eliminate it, but we want to try and get rid of those bits that we think might be of concern to our company. So when we make hedging decisions, we can do the hedging decision in one of four different ways. Four different ways that we can actually, we've made a decision we're going to hedge. We're now looking at that hedge going, well, how do I want to hedge this position? Right? And when I do that, right, if I decide that I'm going to fully hedge, in other words, 100% of my exposure is going to be hedged, right, I will always be at this optimal point, because at the optimal point, obviously, the price has got nowhere to move. Right? Here's my exposure, exposed to spot. I've just locked in a price using the forward market. The price is locked in for 100% of whatever my exposure is. Think back to those, obviously, cross diagrams, the economic clock diagrams we looked at last week. The other alternative is, let me take you up the top here, I can make a decision to be totally unhedged. Being unhedged is in itself still a hedging decision, so long as it's a decision that's made on the informed basis. Okay, in other words, you've decided not to hedge, right? Let me give you an example. Right? You are a multi-billion-dollar company. You want to buy a 3D printer that you basically found on the internet. You want to buy that from New Zealand. You know you're going to have a New Zealand dollar exposure for maybe, say, 500,000 New Zealand dollars. And when you go to actually pay that, right, in a multi-billion-dollar company, 500k really, I'm not going to hedge that, right? Because I don't normally transact in New Zealand dollars. It's a small exposure relative to the multi-billion dollar exposures I normally have. I might decide not to hedge that particular exposure. So under those circumstances, I am fully exposed. Obviously, prices go up, prices go down. I'll have to obviously wear whatever those price changes actually are. But it actually works out to be okay, because what happens is that typically unhedged positions are normally for one of two categories. Normally, it will be that you will not engage in hedging if, firstly, that the exposure is small. Three reasons, actually. Three reasons. One, because it's small. Two, because it's one that is basically, you're rarely ever going to have to do this again. And that goes with the small as well. And then the third is, of course, that when you have these exposures, that it could be that there is just no vehicle or nothing you can use to actually hedge the actual exposure. There is no forward contract out there that you can actually use. There are no counterparties willing to trade for that particular contract. Now, New Zealand dollar, sure, there'll be parties out there that'll be happy to trade that. But if you were trading in some, let's say, precious metal from the back blocks of Myanmar somewhere, it'd be very hard to find, right, a contract you could use to actually hedge that particular exposure, even though obviously the precious metals in themselves would be obviously very, very expensive. So then we start to move into this range between being unhedged to being fully hedged. And this is where most corporates tend to operate. Most corporates tend to operate somewhere between 0 and 100%. And normally what will happen, as I said earlier, the policy process will specify as to how that hedging should occur. And normally you'll find that the policy documents will say if the exposure is greater than a certain quantum, you must hedge. And then they might give you a graduation, like in the sense of graduate the hedging. So they might say if the exposure is basically greater than 100,000, right? Or sorry, start again. They might say if the exposure is greater than $1 million, you must hedge 50%. If it's greater than 5 million, you must hedge 75%. If it's greater than 10 million, you must hedge, let's say, 80% or 85%. And then you find that if it's bigger than that, you might have to take it to the board or take it somewhere else to get the thing approved anyway. So what happens is that as you selectively hedge, what you have to remember is this. And this is why obviously it moves down the line from being totally unhedged in terms of the level of risk that was involved. Because when I partially hedge, what happens of course is that the hedge part is locked in, the price is locked in. But the unhedged portion is still fully exposed. And your risk comes from obviously the part that is still fully exposed. And that's what's creating that risk, that the risk is lower than if you're unhedged because you've locked in some of it, but it's not as good as being fully hedged because obviously you've still got some part of it that's going to be unhedged and therefore still exposed to where the market will be. And then we end up in something that I ask about every year in the exam, and only about 20% of people get it right. Some firms will actually engage in what is called over-hedging. Now, how many of you know what a basis hedge is? A basis hedge. Okay. How many of you doing derivatives? Most of you. Most of you doing derivatives. So put your hand on. Well, you might ask me a question if I put my hand up. All right, so let's assume that you need to hedge a particular currency, right, that you run a regression and you find that there is a certain correlation that exists between your currency and basically the US dollar, okay? And so what you find is that you don't have a currency that's quoted relative to the US dollar, it's actually quoted relative to some other currency, or you have a commodity that there isn't a lot of market out there for that commodity, right? Either way, right, you run a regression, you look at the changes in the price of your asset relative to the changes in the price of what you're proposing to hedge with, and what will happen will be that the hedge ratio that will be determined will be a function of what that beta is based on the regression that you've just run, okay? It could be that the beta might come out at 1. Well, of course, 1 means that for every $1 here, you hedge with $1 over here. If the beta comes out at less than 1, say at 0.8 or something like that, then you might reduce the amount of hedging that you do. You might only hedge 80% of what your exposure actually is. You could also get an outcome where it might pop out at 1.5. And if that was the case, then that would imply that you need 1.5 units of whatever the hedge is in order to be able to obviously hedge what your exposure is. Now, when you do that type of basis hedging like that, right, or through a hedge ratio, that's beyond the scope of this unit, by the way. But when you do that, what happens is that, of course, so long as you get the levels right, in the sense that you've worked out what the hedge ratio needs to be, you put that amount of hedge on, you are still actually fully hedged. Because in order to be fully hedged, you've got to put 1.5 units of this with 1 unit of what your exposure is. And if you do that, you will be fully hedged, okay? However, let's assume that I'm in a market that is a 1-for-1 market. $1, $1 hedge, $1 exposure, $1 hedge. Under those circumstances, what do I need to do? Well, what I'm going to do is, well, let's assume instead of hedging with $1, let's use $2. And why am I going to do that? Because right, I'm exposed to, let's say, a price decrease, and in so being, because I'm exposed to a price decrease, I go out and I decide to hedge that. And when I hedge it, I actually hedge it with a double up on the hedge. Well, the moment I've done that, what I've now done is, of course, I've actually got a hedge for 100% of my exposure, but I've actually got a speculative position for the other 100. And why is that? Because obviously the hedge is only intended to cover whatever your spot market exposure actually is. The hedge is not expected to cover basically the spot market plus this extra bit that you've added on. So there is no relationship that says you should use 2 units of hedge for 1 unit. You've chosen to do that. And so you get 1 unit covering 1 unit, but the second unit becomes a hedge, becomes a speculative position. And when you do that, it's ultra dangerous, because what will happen will be that if you get it wrong, if the market doesn't move in the direction that you want it to, you will still be overhedged, but of course you're going to get a very minimal return. And the reason will be because obviously you're now going to eat into all that protection that you thought you actually had from the original hedge. The second element will be, of course, you're suddenly starting to increase your risk again. So these 4 different locations tell us about what the effect is of hedging on expected returns. And it's quite important, obviously, that you get some sense of these, because as we start to talk about other market risk things later on and other things, you need to obviously understand where these sit relative to each other. Okay, now, this is a slide that you saw way back in week 2, right? And in week 2, what we said was that when companies come to actually think about their hedging, right, as much as they're going to think about, well, do I fully hedge, partially hedge, selectively hedge, what do I do? They're also going to make decisions about the style and type of hedge that they're going to use as well. So they're going to think about things like, obviously, well, do I simply, as a company, just try and avoid the risk? In other words, it's not a market that we trade in, therefore I should have no reason to buy a particular currency. It's not an interest rate that we would normally expose ourselves through investments or through borrowing. So therefore, I would just avoid the risk by not participating in those particular markets. Alternatively, we might choose, as was the case with my photocopier earlier, we might choose to accept the risk and retain it. In other words, we know we are exposed to a particular type of risk. The risk is small, it's going to be infrequent, or there's not a simple way that we can hedge the risk. Then we might decide, well, okay, we still want the photocopier, so we'll still expose ourselves to the New Zealand dollar, but obviously we're not going to hedge that exposure on the way through. The third way we can do this is, you might remember we talked earlier in the semester about how when you are basically trying to assess your risks, one of the things that you try to do is you try to work out as to what you think the probability is of what the impact of it is going to be, so the probability that the thing will occur, and also as to what the consequence will be, in the sense of, and we fill out one of those risk matrices, for example, based on where all our risks sit relative to each other. Well, one thing we could do is we might be able to use some internal controls to minimise what our risks actually are. We might be able to, for example, the fact that we have segregation of duties is in itself obviously a prevent control, right? And therefore, by having that, we actually minimise our exposure to fraud that could happen if we didn't actually have that in place. Next up, of course, obviously, apart from the internal controls, we might just use diversification. We might simply just diversify our risk by holding a portfolio of a range of different risks and let the diversification impact take care of those risks. You saw that last week when we were talking about the economic capital, how you can reduce the overall risk of the firm by obviously just having different correlations between the different business units to obviously try and reduce where that risk is going to be. And then, of course, we could also put in place various contingency plans. So the contingency plans could be that we might put guarantees in place, or guarantors might act on our behalf, or alternatively we might have set up arrangements with other firms in our supply chain that in the event that certain things occur, that they will give us rebates, they'll prepay rebates to us rather than having to wait to actually receive our rebates at some future point in time. What you'll also see is that, of course, if I have foreign exchange exposures, if I've got trying to manage liquidity risk, I do a lot of matching and netting of cash flows as a way of trying to actually manage risk as well. When I do that internally within the firm, so therefore I'm trying to reduce the risk by obviously using internal methods yet again to obviously do that. Now, the sort of approach that most of you guys would be familiar with as being the straight up method, of course, especially if you're doing derivatives, is you just transfer the risk. You transfer it to a third party. And the third party, of course, will be whoever you have as your counterparty for the actual risk itself. So in other words, whoever you're dealing with, the bank. Or alternatively, you might use insurances. You won't be able to use insurances for market risk exposures, but you can for business risks, obviously. And then you might also, obviously, use an approach where you might actually negotiate with other parties in your supply chain and set up what are called bilateral contracts with each other. And the bilateral contracts, of course, are two-way contracts that exist between you and a supplier, or you and someone who is actually at the distribution or retail side of selling your products. And so therefore, again, these these external contracts, these bilateral contracts, are obviously can have derivatives and risk management features built into those along the way. Now, we'll talk a little bit more about those later on, the bilaterals and so forth. All right, so if you're going to do a hedge, well, of course, you've got to make sure that your hedging lines up with, of course, your corporate strategy. You've got to make sure it lines up, of course, with what's happening in terms of your firm's risk management policies and so forth, the board's risk appetite. The board would have already pre-specified the amount of exposures that you're allowed to hold through the risk appetite, risk capacity, risk tolerances. And then, of course, obviously the board itself, by virtue of giving you delegated authority to actually act on the company's behalf as the treasurer, you can now go and transact with banks and other institutions to actually set up these various hedge type arrangements. One of the things that obviously most boards realise is, of course, that nobody can predict the markets. We can all have a view as to where markets will be, but nobody can predict them. I just about fell off my chair a couple of days ago when I saw that the Aussie had gone to 71. So when did that happen? Right? Because in my mind, I've anchored myself, the Aussie's been sitting around 75 for probably the last 2 years. But just in this last week, it's actually dropped 400 pips all the way down to 71. Still don't know why. Maybe it's a change of government. I know, political uncertainty, of course, yes. Okay, so, and then of course the other thing that you want is that when you have made decisions about, obviously, and this is the board needs to be aware of this as well, is that once you've actually got limits in place, once you're told as to what you're authorised to trade in and which markets you're authorised to trade in, then you need to make sure that when this is actually being set up, that of course those decisions about whether you fully, partially or unhedged or whether you overhedged, well, because these decisions have to stand the test of time. So in other words, right, we can't be going back to the board every 6 months and changing our policy just simply because we're in the heating oil market and we're in summer versus being in winter. Right, we've got to actually have a policy that's robust enough to cover us through both of those time periods. You can actually set in your policy that if it's for winter delivery that this will be the range, and if you're in summer delivery this will be the range, but you just put that into the policy rather than having to go back to the board every 5 minutes to obviously deal with it. So when treasurers sit there and try and work out as to how obviously the hedging should actually occur, what you'll find is, of course, that they will go through a process that obviously is very similar to what we talked about with regard to, of course, our risk control type process. There's a lot of analysis will take place. You'll do analysis where, of course, you'll try to identify if there's any natural offsets, and if there are, you would quantify them and work out what is the impact of obviously using netting or matching opportunities or borrowing, investing, or using commercial hedges or whatever it might be. You'd also do an evaluation, of course, of whatever these different approaches will be. And you might run 2 or 3 different scenarios, 3 or 4 different sensitivities, and see what the impact of having these hedges in place is likely to be. You'd also make sure that as part of obviously doing your analysis that you've also assessed on a cost-benefit analysis basis as to whether or not there are actually other costs that you need to take account of. There could be fees or charges, or it could be collateral costs where you've actually got to put money on deposit in order to be able to do certain things. And that money then becomes basically locked down like in a trust account such that you can't touch it until obviously the transaction has obviously been finalised. Putting cash aside like that, at best you'll get the cash rate. So therefore you're not going to be able to get the same sort of returns on obviously whatever that cash actually is. And then, of course, you need to make sure that everything's done in accordance with, of course, what your strategic requirements actually are. So, when companies basically try and use derivatives to do hedging, right, what happens is that it's almost like a soft option. It's almost like a sort of an easy option, if you like, for corporates. I'll just use the forward market, right? But it still requires a lot of robust thinking, because you have to sort of weigh up quite a few things here. You've got to weigh up the fact that you've got to have a banking relationship for starters. You're going to have to put up collateral, whether you're trading on an exchange or over the counter, right? You as a corporate are very rarely ever going to be in the strong arm position with a bank, right? Or for that matter, with a trading exchange. Exchanges will always want to have the exchange still existing next week, so they're going to require you to put up collateral for any positions that you have. They're also going to mark the contracts to market on a daily basis, revalue them every day, and as the price moves, so too will the amount that you have in your account will move as well. So you could actually be called upon to actually give more money in the form of collateral if the price was to move adversely during the period of the hedge. And so this becomes an issue because, especially on long-dated hedges, right, the long-dated hedges become a problem because obviously if you're holding money in collateral, as I said earlier, you can't use that collateral money whilst it's actually being used as collateral. And so therefore, because you can't use it, that means, of course, then that you've got to go and borrow more money to be able to meet whatever your requirements actually are, right, within the company. And of course, when you borrow money, you'll be paying a higher charge than what you'll be getting as the interest rate, as a cash rate on the actual on the collateral itself. So let's assume that you go down the path of actually deciding to use forward contracts. Well, forward contracts basically are one of two types, and I think I talked about this briefly last week. Right? That forward contracts can be one of two types. They can either be what are called deliverable forward contracts, or alternatively, they can be non-deliverable forward contracts. Deliverable forward contracts typically involve the actual delivery of whatever it is, the commodity, interest rate, FX rate, whatever it might be. It actually involves the actual delivery of what it is. If you've agreed to buy 1,000 bananas on X date, then you must buy the 1,000 bananas on X date, right? If you don't like bananas, you're going to have to get rid of them. You're going to have to sell them, right? But nonetheless, obviously, you need to do that. Alternatively, the non-deliverables, and this is why increasingly more and more hedging is moving towards non-deliverable, is that the non-deliverables normally are cash-settled contracts. And in fact, globally, most contracts these days are actually set up to actually be, obviously, non-deliverable contracts. The flexibility of a non-deliverable contract means that I can get on with my business and run my business and know what all my exposures are within my business, and then I can deal with my bank separately, and then obviously that means that, of course, the bank will have a forward contract with me, but I've also got a contract to actually sell those bananas to someone here within Australia. So in other words, it allows a lot of flexibility for the corporate to be able to have non-deliverable forward contracts. Also, what happens, of course, is that when you have non-deliverable, when you get to the maturity of the contract, we benchmark the market price vis-a-vis where the agreed price is under the forward contract. And what will happen will be that you will either have to pay or they will pay you the difference between where the spot price is on that future day relative to, of course, where the forward price will actually be. In contrast, futures markets are basically markets that run on an exchange. Everyone basically these days electronically trades on the exchange, but in the old days people used to be there, outcry, calling prices, and then people would agree transactions, and those transactions would then be obviously booked on the exchange. Futures markets, very large for things like equity, short-term interest rates, etc. Not very big when it comes to things like commodities and also foreign exchange. There are futures markets for those things, but obviously not as prolific as what there is for interest rates and equity. Swap contracts. Well, swap contracts are a very simple concept, right? under terms of a swap contract, we enter into a contract that allows us to swap one set of cash flows for another set of cash flows. So for example, right, in an interest rate swap, I might have an exposure to increases in interest rates. I'm going to be borrowing in the future, or alternatively I have borrowed, and obviously interest rates could rise. If they do rise, it's going to cost me a lot more money. So what I do is I enter into what is called an interest rate swap agreement. Under the terms of a swap agreement, what happens is that we agree that every 6 months or quarter or whatever the frequency is of the borrowing, that what we'll do is that we will swap. And what will we swap? We will swap cash flows that are linked to the interest rate. So what happens here is that if I'm a borrower, I'm exposed to obviously interest rate increase, so therefore I will enter into what is called a buyer swap. And under a buyer swap, that gives me the right, obviously, to be able to actually pay fixed under the swap. I pay a fixed rate, and I receive a floating rate. So I pay an agreed fixed rate, and then receive the floating rate. And the idea is that, of course, right, I pay fixed, receive floating, but of course I still got my borrowing. And because if the interest rate's gone up, that means that, of course, the bit I receive is going to be able to offset what that rate will be in terms of the physical borrowing. So in other words, the floating cash flow I get in can offset, obviously, the cash flow out on my actual borrowing. All right? Now, that's great if interest rates go up, I get that benefit. The trouble is, though, because if interest rates go down, I'm paying fixed, but what's going to now happen is that I have to actually pay you. I'm going to pay the bank. And what I have to pay, I can pay the difference the other way. And so what ends up happening is the net cost of my borrowing ends up being equal to whatever the fixed rate is under the actual swap itself. And of course, if there's a credit premium, obviously that would be taken into account as well. So, interest rate swaps, very popular. Most corporates use them these days, especially for long-dated borrowing. The interest rate swap markets for 3, 5 and 10 years are the most liquid markets in the world, both in terms of size and also in terms of obviously just general frequency, volumes and so forth that are actually occurring. Why is that? Because obviously most people borrowing use interest rate swaps. And then of course you know option contracts, right? We all know options, right? You can buy or sell an option. The option can be a call option or it could be a put option. Call option gives me the right to do what? Right? The right but not the obligation to buy in the future. And a put option gives me the right but not the obligation to sell something in the future. Okay? Now, an important point here is this. When you start to look at, obviously, the nature of call and put options, call and put options have what is called a strike price. And the strike price, of course, is the price at which, obviously, you can buy if it's a call option, or it's the price you can sell if, obviously, it's a put option. But in the case of a call option, if at maturity of the option, if it's a European option, if the price is actually lower than what the actual price is under the call option, under those circumstances, a contract to buy at a certain price, I can walk away and say I'm not going to buy. But under a forward contract, I must perform whatever my obligation is. Under an interest rate swap, I must perform exactly what my obligation is. Okay? Whereas the options, you do have this element of flexibility. But what it also means is that when I have forward contracts, that the delta on a forward contract, the rate of change, if you like, in the price of a forward contract, right, moves at a rate that is equal to 1 relative to what your underlying is. In other words, right, if I have a 90-day bank bill futures contract, the rate at which the 90-day bank bill price moves is equal to the rate at which, obviously, a 1 basis point change happens if I actually had a 90-day bank bill. Okay, so in other words, I work out what the value is of a 90-day bank bill, change it by 1 basis point, I can see what that value will be. If the futures market is trading at exactly that same price, or same yield, then again, 1 basis point change, they will offset each other, they'll be perfect offset. That's why you can use these things to 100% hedge. When you use options though, the delta actually changes. It changes. And what happens is that when options are out of the money, in other words, when the price in the call option is lower than where the agreed price is, then basically what will happen will be that the delta will be really, really small. Won't be close to zero, depending on how deep out the money is. When the option is one where we know that the option will actually be exercised because the market is really high, the strike on the option is very low, under those circumstances, the delta will approach 1 again. But in between time, when it's right at maturity, where does it sit? What numbers does it sit at? It's right at the middle of the distribution, isn't it? So it's got to be at 0.5, okay? So what we find is that with options, they actually don't behave in the same way that forward contracts do. And this is what, if I go back to where we started tonight, this is what obviously spooked people back in the 1980s and 90s, because people didn't understand them, they didn't understand the instruments, they didn't understand how the instruments behave. They couldn't get their head around the idea that something, when the price changed, it didn't just move by the same amount as what your exposure actually moved. It moved by a different amount through. Okay, just let me tell you a quick little story, and then we'll have a break. Okay, so here's our quick little story. A German company in 1993, Metallgesellschaft, right? They were a company that specialised in heating oil that used to be purchased and then sold in Europe. German company. Okay, and what happened was that this particular company, what they would do is they had a sales team that would go out and sell heating oil using forward contracts. Okay, sell. Go out, sell as much heating oil as you can for the upcoming winter. And then what happened was, of course, that you have a treasury that then has to hedge those sale contracts. Okay? So in other words, I go out as a member of the sales team and I do a big sale. I bring that sale back to the office, and then the treasury team would then obviously take over that contract, and they'd look at it and go, well, we can hedge that by using heating oil futures contracts or forward contracts, and obviously set the hedge in place. Okay? The only trouble is that for heating oil, you can only get heating oil contracts forward out for about 18 months or so. Right? So in other words, you can only get heating oil contracts forward, in other words, forward maturities, out to about 18 months or so. And so what they used to do was they used to use what was called a stack and roll approach. Some of you might know what the stack and roll approach is. In the stack and roll approach, what happens is this, that we work out how much we need to do the hedging. But we also know that our exposure is not just 18 months, but it might be, say, 2 years or 3 years from today. So what we do is we roll the contracts forward. So in other words, as the first of these batch of these contracts hits their first maturity date, which could be in 3 months' time, so we use futures or forward contracts, they hit their maturity date then, we roll those contracts forward. Now how do we do this? What we do is we basically unwind the hedges that we have for 3 months, and then we reposition them at the end of 18 months. Right? So in other words, we go, here's the first 3 months, we'll hedge that. At the end of the 3 months, we'll then pick up all those hedges and we'll roll them forward, and we'll put them at the end of 18 months, which means then we're hedging 18 to 20 months, or 21 months. And then we do the same thing when we hit the end of 6 months, we then go forward again, that becomes 21 to 24 months. So the nature of how they did this was that by keeping a very close link between the maturity of the sales contracts and obviously the maturity and their ability to do this stack and roll, allowed them to obviously hedge the exposures that they actually had. Well, that in itself requires a lot of good communication, doesn't it, between obviously the treasury team and the sales team. Also, you want to make sure the treasury team is quoting prices in the market that don't diverge too much from where the actual forward market actually is, because otherwise, you know, you'll be hedging, but you won't be hedging the price they've actually quoted. But you've got to also look at it from an incentives point of view. The actual guys that are the sales team, how are they rewarded in their performance? By making sales. Right? They're rewarded by making sales. That's how they get rewarded. The treasury, how does it get rewarded? Well, it gets rewarded by its ability to hedge and to perform well relative to obviously what those hedge requirements actually are. Well, you can see the picture of what's evolving here. What happened was that the sales team decided they would go on a big selling splurge. One, it was in summer, they set up for the following winter, and then said, well, if we're going to hedge out the following winter, let's not just do it for the following winter, but let's do it for the next winter and the winter and the winter. And they were basically running sales contracts that ran out for 5 years or more. But of course, remember the hedging vehicle, the hedging contracts, at best could only go out 18 months. So you can almost picture what's going to happen here. We've just locked in sales at a fixed price for the next 5 years. Fixed level. You've got obviously a sales price that's probably marginally higher than where obviously the current 18-month price is, because that's where the stack and roll is going to place you at the next rollover, next reset. But what happened was, of course, they said, well, given we're doing a 5-year contract, we'll actually push the price up a little bit higher. So they're actually selling a little bit more higher because they had the guarantee that we'll deliver this oil to you for the next 5 years. So obviously on that basis, you can pay us a little bit more, but it's all consistent with where the prices are going anyway. So then what happened, of course, was that as Mattel Shell Shaft tried to hedge these giant contracts that had been put in place, what happened was that the underlying spot price did what? The general level of prices started to rise. And eventually, over time, what happened was just the actual underlying spot price, let alone the forward price, the spot prices were above where, of course, the actual market was saying, where these sale contracts had actually been set up. So what ended up happening was the prices at which that they could actually hedge their future exposures were actually prices that were actually higher, right? Prices at which where they could actually, lower. Get this right. The prices at which they could actually hedge the exposures ended up being prices that were actually higher than where the actual market was previously. But what it meant was that they were actually lower than where the sales prices ended up being. And as a result, what that meant was, put in very simple terms, it meant that what happened was that they had to go to market and buy the actual oil at a price that was actually higher than the price that they're actually selling the actual oil at to these people under these big long contracts. And that's something that's unsustainable, right? You just can't do that time after time after time. And as a result, these guys lost about $1.3 billion. Now, Mattel Shaft still exists. It's still out there. It's a lovely company, still exists. I'm not sure what it is they do these days, but I don't think they're in the heating oil business anymore. But if you Google them, they'll pop up on the interweb for you as well. So, put yourself in the shoes of a corporate treasurer from a market risk perspective here. Obviously, here you've got a couple of problems. You've got a disconnect between the sales team and obviously the actual upfront team. You've got a second problem. What's the second problem? The second problem is who's actually doing the analysis? Who's actually working out as to how long these hedges should actually be, and therefore how long the authorised selling contracts should actually be. You shouldn't be selling beyond the range of where you can actually hedge, is basically the lesson, okay? You shouldn't be selling beyond the range of where you can potentially hedge the exposure. And so that ended up becoming quite a significant loss for these guys. They did lose a lot of money, and a lot of it came off that inability to actually be able to run the trading strategy that the Treasury was obviously historically running. Okay. Tell you what, why don't we have a short break? Okay, come back after the break, and I'll tell you about these guys. This is unbelievable, this one. This is a good story, this one. Sure, why not? Why don't you come around this side, might be better.
In here,
in here.
As for the note, there
Yep.
were about the comparator.
Yep.
And if this means that we should use the lecture for the question tag calculation method to estimate the
No, not necessarily. You drive your computer. Go back to the question again.
yeah, here.
Okay. So in the thing here, if you look at the wording here, what does it say? It says here that you've got to use the EBITDA,
Yeah,
right, from that to that,
Yes.
using CDAR, right, for the company. Right. Now, what some groups might choose to do is they might say, well, if I did this, I only get about 60 observations.
Yeah,
Right?
we
So
already give
I
them-
might go, okay, well, maybe I can actually get some more observations. If you want to get more observations, where would you get those from?
the comparator.
Comparative. Yeah, right.
So if
so you
we-
don't have to do that for the purpose of the exercise. You only have to collect it for your firm, right? But I'm just saying, I'm putting a note there saying that obviously if you choose to do this, that you got to make sure that obviously I know that. But secondly, you need to make sure that obviously you're putting the appropriate assumptions in,
Okay.
right? Because if you go back to what you showed me a moment ago, the other thing, yeah. Scroll down for a sec. Right. Okay, all right, so notice here, right, that I'm trying to drive yours up this. Okay, see we say here, right, that you should, right, estimate the ratio of EBITDA to assets. Right, so if I've got 2 or 3 different firms that I'm collecting all this EBITDA data for, some firms could be really big, some could be really small.
Yes.
Right, so therefore, when I'm actually trying to work out which EBITDA is relevant to my company, there is no point in me putting my company in a distribution with other EBITDAs if I have a really large company, because the really large company is going to have big skew in terms of where their data will sit relative to where my data will sit.
Yes,
right?
makes sense.
So what I do is I condition the data by expressing it relative to assets. So in other words, when I actually run the at-risk measure, I actually run it as an EBITDA at risk that is based on EBITDA divided by assets.
So if we use this method to estimate the EBITDA, but I think there is a huge question because different companies have different ability to make profit. So if we
correct.
use 4 companies, so
Yep.
I think there would be a bias because different companies have different.
Well, obviously this comes back to how you choose your comparators. Because comparators are supposed to be companies that are like your company, that are similar to your company, similar industry, similar types of exposure, similar business model. Right? You'll never get perfect matches. You'll never get companies that perfectly offset each other.
Another question is here. And as for the sensitivity analysis,
Yes.
I think if we should use a regression method to plot a graph about the EBITDA and the hedge ratio, so we could analyze.
Well, you could, or notice I don't actually say there to perform a quantitative analysis or a qualitative analysis, right? So I'm leaving that for everybody to decide for themselves how they want to actually
So we
treat that.
could both do quantitative analysis and qualitative.
Well, even if you do a quantitative, you still got to do the qualitative bit with that anyway to explain your result, don't you? Right? Whereas you could answer these things by doing a qualitative type analysis. Okay? So let me give you an example. Go back to section 2 for a second
Section 2.
of the assignment. Right, so obviously you get exactly the same sensitivities there.
Yes.
But if you're looking at free cash flow, right, then depending upon how you measure free cash flow, right, there will be an impact of interest rates or there won't be. Right? So if you use net income and work it backwards, you've got to adjust for interest rate cost. But if you go the other way and you do it as basically sales and then down to free cash flow that way, right? So operating profit, plus the minus the capex minus the other thing, right? The working capital, right? Under those circumstances, you would not have to, when you have to look at the interest rate and go, well, how's interest rate likely to affect that? Because it's not going to affect it, is it? Right? But this is where I want you to think here, and I've said this to a few people now, so I don't know what I'm saying. I want you to think not just about what the direct impacts will be.
Yes, I think there are huge
there may be some indirect impacts
So
as well.
because of that, I cannot give the formula about the.
That's correct, absolutely. And again, this is why, again, notice here again, I don't say use a quantitative or a qualitative analysis here. Right? I just say discuss the impact.
I think I get that point. Thank you.
Good man. Hello, 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 hello.
We are going to have a trading game
Trading assignment for you.
derivative.
Offer derivatives. Okay.
Yeah, but the system only open from 8 p.m. to
8 a.m.
Do you need to leave?
yeah.
Yeah,
Okay, that's fine. That's fine.
And we have one small question
Okay, all right,
about
okay.
well,
We're just on that. The lecture's recorded anyway, so you can always hear the bits that you've missed anyway. Yeah?
yeah.
Yeah, so that's okay. But thank you for letting me know.
We have a question about the intrinsic risk
Yes.
and residual risk.
Okay.
What's the difference between these two risks?
Okay, all right, okay. Intrinsic risk is the total risk that you are exposed to, right? So let me give you an example. If I am I'm a miner, I mine coal, okay? I am exposed to, of course, the price of coal, okay? So my intrinsic risk is the price of coal and the fluctuations in the price of the coal, okay? Because that could affect the firm value and also affect, obviously, what my market risk exposures will actually be, right? So that's number one. Number two is that then we move on to the residual risk. Well, what happens if I actually hedge the actual exposure? If I enter into a hedge contract or I put some other control over the amount that I'm actually willing to actually be exposed to through limits, or I do something that actually curtails the exposure I actually have, then what I'm left with is obviously a residual risk. So it's basically, so the difference is when you have the intrinsic risk, this is the total risk when you are unhedged. The other is the risk following the hedge. So the residual risk is the risk that's still left after you've actually hedged the risk, right? So let me give you another example. Let's say, for example, that you have exposure to foreign exchange, right? And what you choose to do is to hedge 100% of the exposure. From a market risk perspective, you can say, well, I've actually minimised my risk. The risk should be offset between the forward contract versus obviously the other contract. From a market risk perspective, the residual risk should be zero. Okay? However, I've now, by virtue of putting a forward contract in place with a counterparty, I've now introduced credit risk instead. So in other words, whilst the market risk part might be covered, I've now introduced credit risk. So I need to consider what the credit risk aspect of this transaction might actually be down as well. All right, very good. Thanks for letting me know also, guys. Hey ho, how are we?
Good. Just something with the...
You realise that you've already done your quota by asking lots of questions last week. That's all right. What do you got for me?
Yeah. No. So the first one is actually...
I don't know what's happened to these two blokes that sit down the front here. Where are they gone? They've disappeared.
Yeah, I think they maybe went to interview in another... I don't know. I just so like, you know how when we talk about... Like you actually want us to perform a sensitivity analysis of the result, but with respect to which variable? Like EAR or EBITDA or all of the variables?
Of the results, plural.
But it doesn't specify which result. There's all these results are
Plural.
I kind of
know.
okay.
Absolutely.
Because like, well, you can actually do
What
that
is it?
with, like a lot of
Right. This stuff up here, until you get down to about somewhere here, right, is all about EBITDA. This bit in the middle here is about, and this bit down here is about.
economic.
There you go. 3 bits.
Okay. Yeah. And can you also elaborate a little bit more on the top-down approach, like in terms of the scope? When we talk about like top-down, do we look at the whole industry first?
No. Oh, sorry. Well, it depends what it is that you're actually referring to. You tell me what it is you're referring to, and then I'll tell you what I mean.
So, like, if we were to find if we were to calculate the EBITDA, right?
Yes.
If we based on the top-down approach.
Okay, so to do that, to do that means that you've got to actually look at your company, because it does say to look at your company, right? So you get the data for your company, right? So all up, you'll get the quarterly observations from 2003 or something to 17. That should be about 60 or more observations, all right?
Yes.
It's been more than 60, I think. But anyway, so what happens is you've got 70 odd observations. Then what you've got to do is you've got to say, okay, well, the question is now saying for us to do this, right, and work out the EBITDA at risk. Well, to do that means that then I just go into a process of doing the calculation of what the EBITDA risk is. Yeah. So a top-down approach basically means, right, because the top-down approach doesn't come into play, right, until we start to talk down a little bit further about obviously the economic capital, right? So the economic capital says, right, based on top-down measure, yeah, blah, 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 all right? So, whereas up here we don't talk about a top-down measure up here, right? So we just talk about the fact that you're actually going to use a value at risk type methodology, but using EBITDA at risk to do the calculation.
Okay. So once you move to the economic capital, you actually use the top-down approach.
Well, you got to use. Well, we're saying this direct, because it would take you a month of Sundays to do a bottom-up approach.
Especially for the economic capital.
And there'll be bits of it you just wouldn't be able to do anyway.
Yeah. Okay.
Right? So I mean, how would you quantify the business risk?
Well, either top-down approach or bottom-up approach.
well, if you use the earnings at risk, right, using EBITDA, you're actually capturing both, aren't you?
Yeah, but that would be more like a top-down approach because the EBITDA already incorporates.
Yeah, it already incorporates the business.
Oh, you assume that incorporates
that's how you're talking. Yeah, because right, where are commodity prices? Where are FX rates? Where are those things going to be mostly impacting? They're going to impact EBITDA, aren't they?
Well, yeah, I guess so.
Right?
Yeah. So, I mean, a top-down is just a lot easier than a bottom-up.
Well, top-down makes it easier for you guys to do what I'm asking you to do. Right? Otherwise, I would need to give you a lot more information to be able to do this. All right?
Because I thought the fact that we already used the straight figure from the financial statement is already more like a top-down approach because you look at the top level, like the end result.
Oh, okay.
And not as in terms of...
Okay, all right, I know where you're coming from. Right.
That's what I thought.
Top-down approach means, as opposed to a bottom-up approach. Bottom-up approach means that you look at all the different bits and you build it up.
Yeah.
The top-down approach means that you look at the top figure and then basically use that to assume something about what all the other figures are actually like.
And the top figure refers to
EBITDA.
Okay. I thought you actually look at the industry as a whole and then
No. The fact that you're actually calculating the fact that you're calculating an earnings at risk, right, using EBITDA, and then you're going to calculate your economic capital using that earnings at risk figure.
Which means it's a top-down.
It's got to be top-down because you've used the EBITDA figure to do the actual calculation.
Yeah, because I wasn't sure what you mean by top-down approach and what kind of scope it involves. Okay.
Yep, my question is on other stuff.
Other stuff.
Yeah, can I ask about is it about part two actually?
He's doing his part.
So we're trying to look at the free cash flow of the company, and then we found two ways.
Two actually, there's actually three.
Yeah, one as in the
Four actually.
Yeah, the one with the full breakdowns in the net income, depreciation, change in net working capital, and also the capex. So then we have one set of figures for the free cash flow, and then there's the second way, which is given actually by the Edgar report by Alaska, within Alaska. So then they simply define it as the cash flow generated from operating activities minus capex, and they have their own set of numbers for cash flow generated by.
Yep. That's one of the ways.
Yep. And then the two.
Yep. But you'll find that,
that
they won't match. That's right, because they're actually making different assumptions.
Yeah.
Right. But you can actually adjust the operating cash flow. You can actually adjust it so that they do actually make each other equal each other. And the reason is this, because obviously the cash flow statement should just be representing the change in variables that's attributable to actually cash flowing around, right? And therefore, given you're trying to measure free cash flow, it should just be cash items that are actually moving around, right? But you still need to take account of things like obviously depreciation and other things. Otherwise, you're not actually doing, because if I just look simply at the change in cash flow from operations, it's not going to have all the attributes of what I need to actually measure free cash flow. So the approach that the Edgar guys use is a very, very simplistic way of doing it.
So actually the detailed approach is more optimal in this case.
Well, I think the assignment actually says to you to actually detail the approach you've used anyway.
Yeah, instead of the one just given by the company. So,
there are websites you can go to, you can just pull a figure down as well.
Because they're giving very different trends as well.
So yeah, can we actually extract directly from the database in terms of like the free cash flow? Do we actually have to show the whole process of like
Good question.
Or do we just reference where we get our source from?
Report must clearly show and discuss how you come to your conclusions regarding your analysis.
Where we extraction from data.
Tell the client that and then send them a bill for $50,000 the week after. Yeah. We looked up
We actually have
Bloomberg.
to calculate the free cash.
Okay,
Actually
yeah,
work it out,
because
yeah.
I was like, that's already
You gotta,
given somehow.
well, I don't know how you could do the sensitivity analysis properly if you didn't actually lay out what the cash flows are anyway.
Yeah.
That's true. For the cash flow.
But then we have to go back and look at the investments and the operating.
Yeah, but you're not trying to calculate what your forward cash flows are going to be here. We're not trying to value this company, right? So we're not saying what's the impact on the value of the company that arises because of changes in the thing here.
But everything is interconnected, so.
Most definitely. But remember, all I'm asking you to do is right. Remember, if you're going to value the company, right, you don't look at what today's free cash flow is. You look at what your future free cash flow is going to be, right? I'm asking you to look at today and go backwards, and then tell me something about the past, not about the future.
So like the way you run like the sensitive test, do you simply like find a correlation and then use that as a base model to say how much change in a particular variable will affect the free cash flow? Or do we actually have to find out the underlying
Well, you don't have to.
drivers?
You don't have to. Well, I mean, I'm going to leave that for you to have a think about, given what the question's asking you.
Because we have to
But going back to the sensitivity analysis, right? It doesn't actually say in that section about the sensitivity analysis that you must perform a quantitative analysis.
Yes. Okay. So.
But you still have to show how you come to conclusions.
Yeah.
Okay.
But the most obvious one would be using a correlation, so that would, yeah.
You can make this as hard or as easy as you want.
Yeah, but
But remember also that. Let me show you. Remember also that at the end, right, be guided by what's here as well. Right, there's 5 marks, which I know it doesn't sound like a lot, but there's 5 marks on the board here for quality of analysis, and there's 5 marks for originality. So you could basically do no quantitative work at all, and you just blow 10 marks and see how you go.
That kind of answered my question.
But all I'm saying is you don't have to do quantitative analysis. Because it would be very difficult to do that, because otherwise how you'd have to run, as you say, whether it's regression or correlation
yeah,
or whatever.
that was literally what we were
or
thinking
look
about.
at covariance type analysis or something. You could do that, but I mean,
But once you get them,
Strikes me as a lot-
but
strikes me as a
once
lot.
you get it, it's easier to make the sensitivity analysis. Once you have kind of a certain correlation with
true,
with the oil prices.
But all right, so you've got free cash flow, how are you going to assess the impact of change of interest rates?
Yeah, so
No, but I was thinking
Where
correlation-
in free cash flow do you actually have interest rates? At best, they're indirect effects, not direct effects.
I mean, you will still be able to run the regression, but it just may not be a direct like relation anyway. Just run.
I'll just be
run
careful how you
the-
specify it.
Okay.
Maybe something I'm going to show you here shortly might give you a clue.
Yeah, the
We can take it.
better the correlation.
Anyway, let me get on with this, guys. Oh, sorry.
Thank you.
Okay, so let's make a start again. So I want to also talk to you about a company called Sumitomo. Sumitomo. How many of you have heard of Sumitomo? How many have heard? Sumitomo, Japanese bank, investment bank, right? Very large investment bank on the global stage. Okay. Well, way back in the mid-1990s, this is one of the most weird and wonderful sort of aspects of, if you like, a market risk disaster that's ever occurred. Okay, let me give you the background. When you trade a number of minerals, the only place that you can actually get high liquidity in terms of forward contracts is to trade them on what's called the London Metals Exchange. And on the London Metal Exchange, the LME, that you trade contracts that are basically similar to futures contracts, but when they're traded prior to 1995, also prior to 1996, that what happened was that all of the contracts were physical settled contracts. In other words, they were all deliverable contracts. So most of the time when you trade futures, most futures contracts, as you probably know, those of you that know your way around futures markets will know that most futures contracts are non-deliverable. There are some deliverable ones, but most futures contracts these days are non-deliverable. But back in the day, these contracts for commodities, especially for physical commodities, used to be deliverable contracts, which meant that if I said I was going to buy aluminium or copper or whatever it was, I had to actually buy it. In other words, I actually had to take delivery of it, right? And then if I was going to sell it, I had to actually bring it to market and actually sell it on the day that it had actually been agreed. Now, I wouldn't walk into the wharf area of London, as you know that you were around London, I wouldn't walk in just near the the London Tower thing. What's it called? Tower of London. Good Lord. Okay, so just beside there is where the wharf area is, where the LME exists. And what would happen would be that you wouldn't suddenly just rock up with, I've got 1,000 pounds of aluminium in my back pocket here, right, to do delivery on the day. There'd be instructions as to where the aluminium had to be delivered, etc. Now, at Sumitomo, there was a guy that was the head of copper trading. And what he did was that he realised that if he could actually get control over the supply of copper in world markets, that meant that he could influence what was going to happen at the LME. In other words, what he was going to try and do was to buy up as much copper as he could from around the world, so that when it came time for parties to have to deliver their copper under sell contracts that they had from the LME, that they effectively had to buy the copper from him in order to be able to sell it, right? So what he did was he went out to the market and through various channels, through Sumitomo and through subsidiary companies and so forth, he was actually able to buy up something, I think it was about 2/3 to 3/4 of the world's copper supply he had access to, okay? Now, having that much copper in your back pocket is a lot of copper, right? And so therefore, when companies then went to settle at the LME, that they weren't able to actually settle some companies. Why? Because obviously they had the problem that Sumitomo had all the copper, and of course what did he do? Of course, well, he charged extraordinary high profit prices in order to be able to gouge the market at that stage. So what you had was a massive disconnect between where people thought the price of copper should be in the market, in the forward price market, relative to where he was positioning it on the actual delivery days because of his power that he had within the market. So this became a real big problem. Also, in order to fund the copper purchases, he had to obviously borrow money, and a lot of that was done, as it turned out, was done fraudulently as well. And so therefore he had to basically fill out lots of forms to borrow money internally within Sumitomo Bank, and those funds were obviously, instead of being directed to where they were supposed to go, were being channeled into the purchase of all these copper contracts. Well, what happened was, and I think this is one of these things that you sometimes think, sometimes there is a little bit of justice in the world. And what happened was that, of course, he was making all these big super profits, obviously, the first couple of periods where he was able to do this. People were getting a bit worried because of this disconnect between what the price was on the final day versus, obviously, where the actual market determined the price to be on the last day. And so what he did was this. What the LME did was this. They changed a very simple rule. And the rule was that, as I said earlier, on the final day of the contracts were always all deliverable. And so what they did was they changed the rule and they said the contracts could be deliverable or cash settled. And the moment you say the thing can be cash settled, you no longer need the physical asset to be able to settle the actual contract. And as a result, that means because he wasn't trading in the actual market itself, he couldn't obviously and then take advantage of where the prices actually were. And what of course happened was that means that he was stuck with all this copper that he bought up, right, through other forward contracts and other things he'd already put in place. And of course, the moment he had all that copper, he's stuck with all that copper up here at this price. The market's gone, not going to happen anymore. Copper price falls, and old mate's stuck with the copper up here at this incredibly high price. And as a result, of course, he suffered a massive loss, or Sumitomo Bank suffered a massive loss as a result, $1.6 billion loss, which at the time was very, very large. I mean, this is on par with, you know, Barings Bank type sort of losses and so forth that were from around that time as well. 1.6 billion these days doesn't sound a lot, but certainly back in the mid-90s it was certainly a hell of a lot of money. Now, I'm going to take you on a little journey before we start talking about commodity risk, and I want to take you back to, now did I also give you a slide to do with Orange County? Yeah, I'll give you Orange County. We might park Orange County for the moment. I want to just take you back to week 3, if you don't mind. At the end of week 3, we had a set of slides there to do with Procter & Gamble that we didn't talk about at the time. And I think this is timely for us to talk about Procter & Gamble now. Oh, Phil, what are you doing? What are you doing? Okay. Oh, come on. Okay. Oh, that's not the one I want. Why aren't you coming up? Ah, there you are. Very good. Okay, so Procter & Gamble. This was a loss that occurred because of market risk, but it had a double whammy in it as well. It also had a massive operational risk within it as well. Okay, so there's a massive operational risk as well as obviously the massive market risk exposure that occurred. Now, Procter & Gamble is a global company involved in, they do a lot of soaps and beauty products and things like that around the world, like, you know, shampoos if you've got hair and things like that, okay? So what happened was for these guys that they basically, I'm sorry, I've got that, I'll get rid of that just for a second. Go back. Okay, so what these guys did was they had massive borrowing exposures around the world, right? And what they decided was, well, we need to think about hedging some of these exposures. We've got floating interest rates in America and also in Europe. We need to hedge some of these exposures. So they went along to an investment bank, and the investment bank, I'll come up in a second with their name, the investment bank said, well, we've got a product, we've got a really good product that we think you can actually use. We've got a swap-based product, an interest rate swap product, but with the interest rate swap product, what it is, it's not a vanilla interest rate swap, in other words, just a simple one of, you know, you pay fixed and I'll pay floating. You'll still pay fixed, but the fixed is going to have a couple of extra things on it, and the floating leg might also have a couple of things on it as well. So it becomes like what we call a hybrid type instrument. And what happened was that because Procter & Gamble was such a big company, and they had entered into a commercial agreement with this investment bank about 12 months earlier as being their number one provider of derivatives and financial advice, they basically formed the view, well, hey, you're the bank, you're supposed to be advising us, therefore we'll take your product, and of course if the product all goes wrong, we'll just sue you, right? But of course at the same time, we expect the advice you're giving to us is obviously good and fair, adequate type advice, okay? So what ended up happening was that Procter & Gamble did very, very little due diligence on the actual model that they were given on the swap contract. In other words, they were given a swap contract, they didn't test it, they didn't do any sensitivity, any scenario analysis, any stress testing, right? Any bar type analysis. They did nothing, basically, other than to say, well, here's the swap, I'll take it on board and see how we go, all right? Well, you can imagine what's about to occur here. I'll just past those couple of swap things there. Now, we talked earlier about what a swap is and how a swap operates, so I won't go through that for the moment. But let's put this into context, all right? Here we've got some data, right, of both the 5-year and the 30-year US Treasury bond market. And what we've got is, we've got the 5-year Treasury rate, which is the red line. We've got the 30-year rate, which is obviously the blue line. Now, if the blue line is higher than the red line, that means the yield curve is ascending. If the blue line is below, then that means the yield curve is descending. Now, what we know, of course, is if the yield curve is ascending, that forward rates are going to be higher than spot rates. Right? So in other words, if we look at a yield curve, the forward yield curve will actually be higher. If we're looking at the opposite and the yield curve is downward sloping, forward rates will actually be below where the current spot yield curve actually is. So in this case, most of the time through the back end here of 93 and all this, so this period 91, 92, 93, you can see the gap is quite large, that obviously there's quite a big gap there between the two. And this suggests that rates are obviously going to increase. So therefore, right, Procter & Gamble, they've got all this exposure to interest rate risk. They look at the yield curve and think, oh, well, interest rates must be going to go up. So therefore, right, this probably means that we should probably be hedging this stuff. But what they should have done was, before they entered the thing, was just have a little bit of a look backwards. And if you look backwards, you see that there are periods where obviously these things cross over. In other words, there are periods of time where, of course, the general level of rates is higher or bouncing around, but also whether the forward curve is actually above or below the spot curve also moves around over time as well. Okay, sometimes the blue line is slightly above, sometimes it's equal, sometimes it's actually below where the red line actually is. So, what did they do? Well, what they did was they entered into a 5-year interest rate swap. The 5-year interest rate swap started off based on an interest rate that was linked to a $200 million notional principal. In other words, we do all the interest rate calculations based on $200 million. Now, under the terms of this swap, what happened was that Procter & Gamble agreed to pay a floating rate of interest in exchange for a fixed rate of interest. Okay, so I'll pay floating and receive fixed. Now, remember I said earlier, if you're exposed to interest rate risk and you are a borrower, that you should enter into a payer swap where you pay fixed, receive floating. Error number 1, they went the wrong way. Right? They entered into a swap where they were basically receiving fixed and paying floating, on the advice of obviously the investment bank. And then what happened was they said, okay, well, when we pay this rate as the fixed rate, right, was set at 5.3%. So locked in for the life of this thing for 5 years, you're going to receive 5.3%. And then what they said was, well, here's what we're going to do. We're going to allow you to hedge your borrowing exposure by obviously paying, in exchange for receiving 5.3%, you can pay a rate linked to the 30-day commercial paper rate, in other words, a short commercial paper rate, minus 75 basis points. So in other words, the short end of the yield curve, in an environment where yield curves are increasing, that means that the spot rate is here. The rate you will pay is actually 75 basis points below where that rate actually is. Okay? So therefore, you're actually going to pay a rate that is actually lower than where the market is right now, even in an ascending market. If they looked at that and went, wow, we're going to save 75 basis points. That's all they must have heard, that's all that must have gone in their heads or something at the time. But then they said, well, hold on a minute, minus 75 basis points plus a spread. The spread. My goodness, look at the spread. Right, and you look at the spread and you think, hold on a minute, so let's look at this spread, let's blow the spread up. Right? Well, the spread, it looks awful to look at, but it's actually really simple. Let's look at what's in the brackets here. We've got 98.5, a fixed figure, right, multiplied by whatever the 5-year commercial rate is, divided by 5.78. So if the 5-year commercial rate goes above 5.78, then this obviously becomes a factor that is greater than 1. So 1 point whatever multiplied by 98.5. Right? Are we okay with that? If the 5-year rate is equal to 5.78, this becomes 1, which means this figure becomes 98.5. Okay? If the 5-year rate is lower than obviously 5.78, now remember, they're looking at this through the lens that says, I've just been given the opportunity to receive fixed at 5.3, right? And this is saying 5.78, so therefore that's much higher, right? So therefore the current rate must be lower than 5.78, okay? So they look at this, they go, well, this is going to actually push this number downwards a little bit. And then, of course, you've got the 30-year Treasury bond price that comes off the back of, obviously, the Treasury bond yield. And what we know, of course, is that as bond yields increase, what happens to the price? Price goes down, all right? But also, if the yield curve remains constant, the price doesn't move a lot. If the yield curve obviously goes upwards, the price goes down. But if the yield curve goes downwards, then obviously the price will move up. Now, what's happening here is we've actually got this thing here that looks like a price, this thing here that looks like a price, and we go this minus this divided by 100. Now, we've also got this other bit of terminology here. Uh-oh. What's the terminology? Well, it says maximum. The maximum of 0, or all this yucky stuff here. Right? Now, what do you think is going to happen here, folks? Well, of course, what's going to happen is that when this was originally priced, right, it was actually done, the deal was done by Bankers Trust. That's the banks we couldn't remember earlier. Bankers Trust. Bankers Trust don't exist anymore. Anyway, when this was put together, right, Bankers Trust already had a view as to where interest rates were going to be moving. They didn't share that view with Procter & Gamble. But also, remember how we said that they would pay, right, the 30-day rate minus 75 basis points, right? Well, they'd already worked out that the value of this thing here was equal to or better than 75 basis points, okay? So as a result, right, what ends up happening is the following, right? So let's have a look-see. So we've got a couple of things going on here, right? So firstly, obviously, we know that obviously if rates fall as a result of the combination between the rates and the 10-year bond rate, okay, if rates fall, the value of the Treasury bonds will increase. The impact of that is that the put option will become worthless. If it becomes worthless, then that will actually have the positive effect of decreasing the cost of borrowing for Procter & Gamble. That's if interest rates fall, okay? But if interest rates rise, the put option will kick in. It will have value. So now that means that they will actually pay the 30-day rate plus, sorry, 30-day rate minus 75 basis points plus whatever the value is under this spread contract. So to give you an idea, here they are in November 93 contracting this thing, right? The first payment that they had to make was going to be in May of 1994. Right? So in other words, the first reset under the swap was going to be here in May of 1994. Now, if you look at what's actually going on here, what's happened is, of course, two things should become obvious. One, obviously, rates have gone up. Uh-oh, that's bad. Yeah? Remember, we just said that's bad if rates go up. But secondly, the second thing that's happened is the spread between the two has gotten narrower. The 5-year rate has actually managed to get itself obviously closer to where the 30-year rate actually is. And as a result, the impact of that, of course, is that it causes then for that put option to actually kick in. And when it kicks in, they actually end up suffering a huge, massive loss. Now, the loss, of course, was, now, why the loss shows as only being about $100 million is because originally Bankers Trust, please go backwards. Okay, I can do that in show and go back. Because originally, Bankers Trust, right, what they did was they went back to them at the end of May and said, well, guys, the spread has actually kicked in. You now owe us about $500 million for the first quarter. Right? That's what the consensus. If you want to try and terminate the swap right now, right, because you've seen the markets moved against you, it was going to cost them something like about 500 mil or thereabouts, right? Anyway, it's actually an interesting story. This is what happened was Procter & Gamble refused to pay, right? And of course, you refuse to pay, it all goes to court. And when it went to court, what happened was they found all these tapes, they found all these audio tapes that had been recorded in the trading room at Bankers Trust. And what happened was, on the day that the actual transaction was actually put away, right, that all the traders were yahooing and high fives and having a big party and everything else, because they knew that they'd ripped off Procter and Gamble. They knew that they'd actually done it, right? And so the court listened to all this, and then the court said, no. But at the same time, Procter and Gamble said, well, we went to them for advice, they didn't advise us properly, blah, blah, blah. And it's like, well, yes, they did advise you because they told you here's the instrument and here's how the instrument behaves and so forth. You chose not to actually go with that information you were given. And so as a result, the court said, well, no, you've got to actually suffer some of the loss. And so what they were made to do was to pay the amount of what the actual loss would have been that they would have suffered during that first 6-month period of the swap. Right? So a 5-year swap, the loss they would have made on the first 6 months, they were told, you've got to pay that. Right? And so that was the loss they ended up making. Now, this particular case is interesting in the context of the events that unfolded because of the model, the hybrid model as well, but also it's interesting because it highlights a massive operational risk failure that a lot of corporates go through. And the operational risk failure, of course, is, the market risk is obvious through the changes in the yields, but the model risk failure, of course, is the model risk failure that comes about because they didn't do any due diligence at all on the model. There was no ownership of the model. There was no trying to work out what happens to this model under different circumstances. No testing of the model, testing the model for suitability for what it is that they want to actually use the actual model for. So a couple of the slides that I've given you there, I'm not going to go through these slides, I'll let you have a look at them for yourself, because there's actually a reference also in the slides to where you can get a little bit more information if you want to. Okay, but what it basically meant was that a lot of companies, post what happened here, realised that when you do things like IT implementations, when you have any models that are suggested to you by investment bankers or by consultants or other people, that you need to put in place a way of actually being able to test those models, test their suitability, to make sure that the model itself is not actually going to expose you to a thing called, obviously, model risk. That means that at some point, as a corporate, you need to have a full inventory of all the models that you're using. You need to test those models. You need to keep retesting the models. As markets change, as models change, you need to make sure the models that you are using are still obviously fit for purpose, that they are still suitable. One of the cases that I sometimes talk about, but I'm not going to this year, of course, is what we call long-term capital management, right? And LTCM built a very simple model, right? They used basically the put-call parity model of Black-Scholes. And whenever they found that there was actually a price divergence, they would try and arbitrage the price divergence. But they wouldn't do that for just hundreds of dollars or thousands or millions. They would do it for tens or hundreds of $millions at a time. And therefore, when they lost out, the market, or when LTCM crashed, they almost brought the whole stock, the whole market down with themselves at the time. The US market almost failed. And what happened was that the other big investment firms had to eat their losses. In other words, they had to basically go, well, we've suffered losses today, but we're going to just have to absorb those losses because we can't pay them out. We can't actually have the government. The government wouldn't step in, the same way they didn't step in for Lehman Brothers, but also the government wouldn't step in to help LTCM. But what the government did do was to move to actually make the other stockbroking firms and the other brokers and the fund managers and the investment banks to not chase up on the losses that they had actually made. And so LTCM just disappeared into the wilderness. Now, LTCM is based upon a put-call parity model from Black-Scholes. Right? Very simple model, but it's a very simple model that only works really well under very strict circumstances. And unfortunately, when we went through the Asian financial crisis, but also through the events of the Russians when they stopped paying their petro bonds in 1997, that actually created the losses that actually then LTCM was then to have to actually suffer along the way. So I'd suggest, notice down the bottom, I'll give you a little reference to look at. Right, it might be useful to have a look at that perhaps. I think in the assignment there's a thing I asked you about model risk in the assignment there as well, right, towards the end. Something there you might want to think about in terms of there and how it might apply. Come on, treasure. Okay, bye. Won't. Okay, right, go, good, go. Okay, that one. Okay, now. All right, so we're going to move on. We're going to talk about commodity price risk, okay? Commodity price risk. So, commodity price risk, okay, there are two readings that I want you to be thinking about that are relevant to this week, but both of the readings that I've got here are actually readings relative to foreign exchange, so you're probably going to have to read them this week, but obviously when we do get to the FX part, you will have to. But certainly the readings I gave you last week from the Allen paper about spot and forward markets, those readings are also relevant to what we're talking about now as well. So, what is it that I want to do in terms of this materials here? Okay, firstly, I want to talk about how do you identify and apply, right? How do you identify and apply techniques used by corporates to manage, to measure and manage foreign exchange risk, and also how do they actually, foreign exchange risk, what? That first one should say commodity price risk. I don't believe I did that. Put it in twice. I must have done the copy and paste thing. Okay, so we'll fix that up. Manage commodity price risk. Price. Yes. Okay, back. There you go. Lovely. Okay, manage commodity price market risk, and then also foreign exchange risk. We won't obviously get onto the foreign exchange risk tonight. We'll just talk about commodity price risk tonight. All right, so here we go. So first up, just a quick reminder, as we talked about earlier in the semester, but it's still obviously directly relevant. Obviously, when you are talking about market risk and how the corporates think about market risk, they must adopt this sort of systematic approach to obviously doing their market risk analysis, because if they don't, if they get the steps out of play with each other, they'll actually potentially make errors in terms of the way they think about and go about executing the market risk itself. So let's go through this, and firstly, let's talk a little bit about commodity price risk, what commodity price risk is, how it comes about, obviously that process element of being able to identify and to be able to establish the context within which the commodity price risk obviously comes about. So commodity price risk is the risk that a business's financial performance or positions that it's holding will be adversely affected by fluctuations in the price of commodities. It comes about because of two elements. There is firstly what is called price risk, which obviously is risk that comes about because of changes in price. And the second is what is called volumetric risk, which means that it is actually to do with changes in the volume that is actually involved in transactions as well. So for example, if I was a producer of, let's say, electricity, right, and I've got a generator, and my generator has got 3 turbines, right, I know that I have the capacity to put out electricity for 3 turbines. But I'm not going to run all 3 of my turbines at 100% capacity all the time. Why? Because obviously that will basically damage them over time. I need to manage them over time, their capacity. But secondly, what it also means is that I also need to be aware that from time to time 1 or 2 of them might be down for maintenance purposes. As a result, when I go to hedge and think about what my hedging will be, I would never hedge 100% of my capacity. I would always hedge to a lower level based on what I thought the timing and what the nature of obviously those outages were likely to be. So therefore, there is always the case that you might get something wrong. So for example, I might, during a peak electricity period, it's 45 degrees outside here in Melbourne, electricity's at a high price premium, we've got all 3 of the generators running, and then bang, one of the generators trips. When it does that, it's no longer producing electricity, which means I can't sell anymore. At that point, obviously I've got the volumetric risk of not being able to produce the volume that I've actually just promised the market that I would actually be able to provide. Which means, of course, then I've got the commodity price risk, because commodity price multiplied by volume gives me, of course, the dollar of what my revenue costs will actually be. The types of sectors that are most likely to be affected by commodity price risk: industrials, minings, metals, energy, retail, and also consumer goods. Anything that is energy, obviously, needs energy to be able to operate, but also where you have inputs. Because when you think about it, the nature of commodities are that commodities effectively become raw materials that are often used in a production process or a manufacturing process at some point. As a result, that means that, of course, the commodity price risk becomes something that will affect just about every corporate. It'll either affect them directly or it will affect them indirectly. For companies that are obviously in manufacturing, they're using inputs that are typically based on commodities, therefore that's going to directly affect them. For companies that are, let's say, service providers, if I'm a service provider, like I'm a consulting company providing services to the mining industry, so as a consultant providing services to the mining industry, I might be an electrician or something that's doing fitting out for mines and so forth. And of course, if there is a big downturn in the price of whatever the commodity is, that means that the mines won't operate. Therefore, they don't need my services as much as what they did previously. So therefore, my capacity to generate money has a direct, if you like, exposure to the price of, obviously, the commodity price of the commodity that's being mined at that mine. So what we find is that within any corporate, that commodity risk becomes a very central sort of idea. And there are three, if you like, ways that commodity price risk can affect on, if you like, the side where obviously things are being bought into the firm. So in other words, on the cost of sales side. So if you had your EBITDA and you've got your gross profit above that, your gross profit's got revenue minus cost of goods sold or cost of sales, and obviously the cost of sales is a function of the input prices of the commodities that are being bought into your firm for production purposes. For you guys looking at airlines, obviously, the jet fuel is probably the biggest commodity price risk that they've actually got exposure to. Okay, there will be others, but nonetheless, the jet fuel is probably the biggest. Now, that means that, of course, from the point of view of a firm, they want to be looking out for any signals or signs that there is a possibility of increased volatility in the price, or increases in the actual absolute level of the price, or if there are breakdowns in correlations between prices of instruments that are out there. Now, what we know is we know jet fuel prices are directly linked, correlated with the actual price of oil. So therefore there is a correlation there. If the price of oil moves, obviously that has an impact on the jet fuel price. And therefore that means as an airline company, you are going to be exposed to any movements that actually occur there, given that you're buying in the actual jet fuel itself. But at the same time, the company that's supplying you the jet fuel, they also have an exposure, because to them, there is always the possibility that jet fuel could actually decrease in price off the back of obviously oil prices coming off. So what then happens is that it means that we need to think about aspects related to procurement, related to inventory, and related to our sales elasticity, the ability to actually pass on those price changes when they actually occur. If we're in a highly competitive market like the airlines industry, it might not be easy for us to pass on any price changes of jet fuel. Okay? So we need to have ways that we can obviously manage that. We know also that the jet fuel and other commodities will expose us to price risk, to basis risk, and also to correlation risk. So obviously we need to do analysis that looks to see what the nature of those risks actually are and how those risks are likely to affect us. The types of things that will affect our sales prices off the back of changes in commodity price, things like obviously competitive pressures and whether or not we have the ability to pass through changes that are actually occurring. So just to give you a bit of a sense of things, obviously, if we were in an environment where there were falling commodity prices, how might they affect a company? Well, what will happen will be that obviously if I'm actually directly linked to those commodity prices, this could decrease my sale revenue for producers of the commodity. So in other words, if I'm a miner, if commodity prices fall, I'm going to obviously be exposed to that fall off in price. But in doing that, obviously the sales revenue falling off for the producers potentially decreases also the value of the firm, and it could also mean that the firm might have to revisit its business strategy. In other words, we might have to change the way we do business. Now, BHP Billiton, when the price of steel globally went from $40 to $180 and then back down to about $50, this has all happened over about the last 10 or 15 years, okay? What happened was they adjusted their strategy. They adjusted their strategy on the way up to obviously try and obviously take, to be able to produce, but also they didn't want to use all their reserves up, so they produced but took advantage of the higher price. But at the same time, when the prices came off, what did they do? Rather than basically saying, well, we're going to shut down the mines, what they did instead was they just increased the volume of sales. Right? So if you increase your volume of sales in a low price environment, right, that just means that, of course, you're still going to be able to generate similar sorts of revenue levels, right? Because you can just increase the volume because you've got access to all that mine capacity. Also, if you're in an environment of falling commodity prices, this might also, for some miners, primary producers, reduce or eliminate the viability of production. I mean, we've all heard the story about the gold miner and the price of gold goes too low, right, and they stop mining and just leave the gold in the ground, and then go and basically set up an investment company and borrow against the value of the gold in the ground, right? And they sell shares for 5 years, and then they come back again when the gold price comes back up again. Also, though, not only does it affect on the sales side, but it also could affect on the input side. The lower prices obviously mean that businesses obviously could consume more of the commodity, which in itself could mean that they might be able to increase profitability by producing more, which also could lead to increases in the value of the business. Now, in the same way that I've just done that looking at the falling commodity prices, you could also flip that and then go, well, what happens when obviously commodity prices are going up, right? So what do primary producers do? What do production companies do? What do other companies do in an environment where obviously commodity prices are going in the opposite direction? Now, this looks a bit yucky, doesn't it? Big sigmas and blah, blah, blah. Okay, so what have we got here? What we've got here is, right, analysis whereby we can actually assess how certain risks affect the value of your firm. How certain risks might affect the value of your firm. And so what some companies do is that when they're looking for early warning indicators, or if they are looking to get a sense of which particular commodities have a bigger impact on our firm than others, or alternatively, if they are trying to work out how much and which aspects of our exposure should we be hedging, you can actually do that by analysing obviously the relationships that exist between your company and obviously a set of variables that represent all the different types of exposures that you have. So, for example, right, and let me just run you through this. The idea is that you put in your current equity price return, and you set your current equity price return as in a regression as a function of what the returns were in the last period, which is obviously the way we cover for autocorrelation problems, where you've actually got one period versus the next period. You want to make sure that you're mapping in for efficient market hypothesis, because obviously whatever the returns are today, no doubt probably a function of where the returns were yesterday anyway, right? So there's going to be an element there of collinearity that will happen there. And then we've got this other big squiggly sum thing over here, and these X's, these XJs. Well, the XJs are simply, obviously, this list of other commodities or other factors that are likely to affect what is happening within your company, all right? So if I had, let's say, a big commercial passenger flying airline, I might go, well, here's the equity prices, here's the lagged, like the returns on the equity prices on a daily or a weekly or a monthly basis. And then what I might do is then I might go, well, here's basically what the returns were in the last period. And then I might say, well, hold on, I'm going to be exposed to changes in the fuel price, I'm going to be exposed to changes in passenger demand and supply numbers, I'm going to be exposed to things like interest rates, blah, 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 blah. The list could go on as to the nature of things you might be exposed to. So here's what we end up doing, right? So here we've got a very simple company. The company here, right, we look at it and we go, well, what factors is this company basically exposed to, all right? And we say, well, along the way, what we expect is that this company, right, well, obviously there might be an exposure to the S&P 500. There might be an exposure to the price of bauxite. There might be an exposure to the yield spread between AAA and AA, in other words, the amount I pay on my debt. There could be an exposure to the Australian dollar, and there also might be, for example, an exposure to the price of magnesium sulfate. That might be something that I can actually mine as a byproduct when I try to pull the bauxite out of the ground. So as a result, we do a regression. We run the regression in the form similar to what we had a moment ago. I run the regression, and this pops out as the results of the regression. Right? Now, don't be intimidated by regression results. I know some people get intimidated by these things. But all it is just saying, well, here's basically the return on equity for the company as a function of a constant plus, and then we've got each of the variables, and we've got a coefficient for each of the variables, but we've also got in brackets here a number that represents the t-test, the test to say whether that thing is significant or not. All right? And what we then do is we analyse it. We say, okay, well, look, if I look at this here, I notice that some of these things appear to have a positive relationship to the change in the equity price. Others seem to have a negative relationship. So in other words, the foreign exchange rate seems to have a negative relationship to the return on equity. The price of S&P, the changes in the price of bauxite, and also down here the price of magnesium and the credit spread, they all seem to have a positive relationship. However, it is only the change in the S&P, the changes in the bauxite price, and the change in the foreign exchange that actually are significant. In other words, the others, right, the change in the credit spread, the change also in obviously the magnesium sulfate are not significant. How do I know that? Because the t-statistic is not bigger than 1.95. Right, so it's just standard t-test, run a regression, see what the outputs look like. Now, once I know this information, this is very helpful because what I now can do is I now know that, of course, if there is a change in the S&P, if there is a change in the bauxite price, if there is a negative change in the exchange rate, that this could have an adverse effect on what the change in the value of my equity is going to be. Right? Keep in mind, change in the value of equity affects what? It affects your WACC. Right? And if you're using a top-down analysis, right, your WACC suddenly is very, very important. If you're trying to value your company, which you're not in your assignment, the WACC is very, very important. Right? So therefore, knowing which variables might have some relationship might assist you in some way. All right, now, but there's another aspect to this as well. Another aspect is this, that not only can we actually use this as a way of working out which variables are significant in affecting our firm, what we also can do is we can use this same information to actually say something about, if I was going to hedge, then how much should I actually be hedging? So if I was worried about the fact, right, that I've got currently 1 million shares on issue that trade for $50 per share, right, and in other words, so the value of the shares is $50 million, and I want to eliminate half of the price risk associated with the titanium in bauxite price, the bauxite price actually, not the titanium in bauxite, but I'm looking to eliminate the price of, TB, the price of the titanium in bauxite price over the next month, right, then obviously to do this I can use that actual outputs from that equation. So what's the value of the equity that you own? It's $50 multiplied by 100. Multiplied by 1 million shares. So the value of your equity, $50 million. So therefore, if there was to be a change in the equity price that came about because there was a change in the bauxite price, what we know is from the regression that we just ran a moment ago, we know that there is a coefficient here of 1.1240. We know it is also significant. All right? So in other words, what we can do is we can go, well, my $50 million multiplied by 1.1240 multiplied by the fact that, obviously, right, we look at the titanium price and we work out that changes by less than 10% during the month with 95% of the time. So therefore, we multiply that by 10%, which gives us a value of $5.6 million. So in other words, over the period of a month, we can generate an expectation that based on $50 million worth of shares, that based on our model that we ran earlier, that $50 million worth of shares could be exposed to a change in the titanium price, and if it does change, this is the way it will affect, but it will only affect with 95% confidence, obviously with a 10% change if, obviously, we specify it in this particular way. So in other words, the amount of price change that is likely to occur will be about $5.6 million. Now, if we own these shares, if we're someone who owns these shares and interested in a company through a JV or through some other structure, we want to know what's going to be the impact on, obviously, a change of equity, which then means that, of course, do we need to hedge this? If I had $50 million worth of shares and you said to me that I could lose $5.6 million worth of value over a period of a month, I'd be very concerned. I'd be monitoring and hawking that bauxite price like anything to see just how big that impact is. If I was in the airline industry, I'd be hawking things like the jet fuel price, right? And seeing how that actually is likely to affect me. So how can I actually try to minimise, I won't eliminate, but minimise half of that risk, right? How can I try and minimise half of that risk? Because I don't want to necessarily hedge it all because the price may not move by that amount, you see, because there's only a 10% chance this thing's potentially going to move. Sorry, there's only a chance of 10% movement that could actually occur. So what I do is I set up a very simple algorithm. I just say, well, if I only want to hedge 50% of 5.6 million, that must be equal to a 10% change of what? A 10% change of what value? And the what value, of course, ends up being a value of $28 million. So in other words, when I go to hedge, instead of hedging my $50 million worth of equity against this potential price change, what I do instead is I only hedge 28 million. So in other words, I only do a partial or selective hedge. I don't do the full hedge. Okay? Now at this point, if I do this and I get it right, I will be protected, right? Because I've got the hedge ratio right. I've worked out what the probability is of a 95% movement, right? Being a 10% movement, what's the 95% chance that could actually occur? I've taken all that into consideration. Now, what could go wrong? Well, the price change could be bigger than 95%. Could move you deeper into the tail than what that would be. But that's all right, that just means that you're still protected for that first part, for the first 50%. It's only the other 50% that you're going to have a problem in terms of your analysis. So what are some of the things, therefore, that you should be doing when you think about commodity price risk and you are doing your analysis, you're doing your risk control analytics, that you're doing your other things that you need to do? Well, of course, what you need to be doing is almost like on a spectrum, where you might start out firstly just looking at what your volumetric risks are. Right? What are the types of factors that are likely to affect my ability to bring in this level of production, or to be, what exposures have I got to changes in volume that might occur? Do I have contracts in place with suppliers? What's the nature of those contracts, etc., etc.? And if you're an airline at an airport, you'll definitely have contracts with suppliers, the people that are supplying the jet fuel at the airport. Otherwise, that would be silly. I land the plane somewhere, fill it up, please. I know you don't have a contract. Just leave the plane sitting on the tarmac. You can't actually fly it anywhere, right? That would be a silly outcome. So then you go through, and you might remember we talked about the use of sensitivity analysis, where you look at the impact of a 1 basis point or a 1% price change. And you might have a range of different tests that you might do there, where you're actually looking at, firstly, what's the impact if there was to be a small change in the commodity price? or for that matter, if I have a forward contract, what would be the impact of a small change on the value of the forward contract, or on the swap contract, or an option contract? Which then moves us into, well, what happens when you do have derivatives that are hybrids of some sort, or have option-based features within them, where you have knockout clauses or knock-in clauses that might occur. When these things happen, you need to be able to adjust your analysis, and when you do that, what you're really exposed to is what is sometimes referred to as non-linear price risk. Because you might remember earlier I said that when you've actually got an option, the option payoff changes, the nature of the payoff changes as we move into the money. And what we also find is that it's really good to run simulations, run a range of different scenarios, see what happens when you do various changes and impacts. The scenarios could reflect real world incidents that have happened in the past for that particular industry, or alternatively, you might make up a range of other types of effects as well. And then that leads us then into, of course, the risk control area of looking at things like value at risk and economic capital, etc., etc. So the types of things that I am really interested in, I mean, those of you who do derivatives will remember most of these things from obviously looking at the variability of option prices. But all of these things are also directly relevant to commodities as well, as they are to interest rates, as they are to FX rates, etc., etc. Right? You don't have to just use these techniques for obviously option-based contracts. You can look at the delta change, the impact of a change in the value of something, and see what the impact is on the change in price, how that changes what the value of your exposures are. You could look at what happens if there is a change in volatility and see what the impact of a change of volatility is, that's Vega. Look at what happens if there is a change in the level of interest rates and how that affects obviously what the nature of your exposure. So go back to what we talked about earlier, where we had obviously that cost of carry model, where we had obviously the storage and the spot price and the convenience yield, etc. But you might run an analysis and say, well, what happens if I change the level of rho? What happens if I change interest rates in that model? But the other thing that's always of interest is that for most contracts, they have a maturity. And what you want to know is, of course, how does the actual price change as you get closer and closer to maturity? Now, if you have a locked-in price, you might go, well, that doesn't matter because I'm going to pay whatever the locked-in price is anyway. But what if you had to terminate the contract early? What if you found out that your counterparty had gone bust and you've got to replace the contract with another replacement contract? Right? Under those circumstances, you'd want to know what the value of the contract is on a day-to-day basis. So therefore, again, we can always use theta as a way of obviously understanding the impact of changes in time. So what are the primary things that we can do to manage commodity price risk? This comes back down to this last stage where we've identified all these risks, we've analysed them, we've gone through a process of trying to understand what the risks actually are. And now what we want to do is we're at that point of saying, well, we need to start thinking about hedging. How am I going to hedge these particular risks? Well, as we said earlier, there are 4 general approaches to hedging. Right? Take no action at all, right? To just avoid the risk. Take no action at all. To internally look to methods we can use to hedge, or alternatively, to go external. Okay? Well, if I look at that list there are only 2 things on that list that are external. Right? The 2 things that are external are the long-term bilateral contracting and also hedging using derivatives. Everything else on that list is something that I can do internally, or alternatively, deliberately decide not to take any action at all. Nowhere on the list there is, of course, the fact that I could just avoid the risk and say we don't want that exposure. Well, guess what? If I'm in the airline industry, I'm exposed to jet fuel unless someone comes up with a way that I can turn cordial into jet fuel. All right? So therefore, it's pretty hard as a company to say we're not going to take any action at all. So how can we go about this? Well, what we do is we sit down, we do an analysis. We say, okay, I can take no action. If I take no action, I'm fully exposed to whatever the price changes are. Is that a suitable outcome? Probably the answer to that in a big company is probably going to be no. The other alternative is I could store the actual jet fuel myself. In other words, I could actually pre-purchase the jet fuel and store it in those big giant white containers you see at airports, and then when I need it, that's our jet fuel. It's already been purchased. right? So I could come to an arrangement with a company where I lease those big bins and I'm able to store the actual jet fuel myself in those bins. But that's very costly to do that, right? And also there's lots of risks. You've now got a whole new range of different risks that could catch on fire. There's all the health and safety stuff. You just introduce so many new risks by actually doing something like that. You might look to where you can get some natural hedges. You might look to where maybe the price of jet fuel might be correlated directly to something else that you've actually got within your firm. You might just find by accident that the price of your jet fuel is actually correlated to, let's see, well, I'll use something silly, to the price of actually having to supply everybody with food on the actual aeroplane or something like that, okay? So therefore, in that case, you go, well, I might have a natural hedge here, an offset that I could use, right? And that gives me a nice diversification effect, and therefore I can try and eliminate or get rid of some of my risk through that process. We could use also the bilateral contract, as I said earlier. That's where I contract with the supplier, or alternatively, I contract with someone else who is basically a post where my stage is in the production process. So I, as an airline company, I will have arrangements with hotels, with car hire companies and so forth to obviously pass on business to those people. And those arrangements will be such that obviously then I get certain payments and kickbacks for doing all the advertising for them. Normally you find with bilateral contracts that the contracts themselves, whilst they're normally pretty meaty, they're usually big documents when you go through them, but what you often find is that they actually do allow a lot of flexibility. Right? They allow a lot of flexibility. If I entered into a forward contract with, let's say, a bank, right? It will be a contract that will be set typically for price and volume. You're going to buy this amount on this day at this price, right? And then it'll be either non-deliverable or deliverable. However, if I have a bilateral contract, it's in both our interests to strike an arrangement that is actually mutually beneficial for both of us. And it could be that we might enter into a profit share contract. And the way that will operate is that when the price goes above a certain level, right, that rather than me having to just keep forking out and paying that higher level, that you actually start to we put a ceiling on where the price can go to, and you start paying me back money. So I pay you and then you pay me back, so the net effect is that you're going to pay me if the price goes above a certain level. Alternatively though, I protect you by agreeing to put a floor into the contract. And then if the price goes below the floor, I will actually pay you at the floor price level. And that way you're always got the protection of obviously the downside price. But other ways that you can obviously get into these arrangements is that you might start to protect each other by giving each other intercompany loans, for example. Right? So you might provide intercompany loans to help the other company with their working capital, for example. Or you might give them an intercompany loan that helps them to actually build a new facility at the airport, given that that airport's got very old facilities at the present time and you want to expand the number of flights you're going to run through that particular airline at that point in time. Of course, you can always use derivatives, no drama with that, and there's different types of derivatives that obviously you could use. Or alternatively, again, you could do the thing that everybody wants to tell me about in the exam, even though I always tell you don't use this as one of your solutions, is that you could vertically integrate, okay? So if I'm an airline and I've got Shell or BP at the airport, right, BP and Shell do not want to buy the airline, okay? You also run airlines, you don't run a fuel company, right? So therefore to vertically integrate, yes, it is a potential solution, but it is one that obviously is only going to work if there are massive synergies in place, that it is consistent with what your line of business is, but also it will take you months to negotiate the contract. So therefore, if you have a price risk that is going to happen somewhere in the next, say, 6 months, suggesting as a solution to that problem to vertically integrate is not appropriate, right? Because it'll take you 6 months to set it up, and even once you've set it up, who says that all the synergies will actually work? It might take you 2 years before the actual two companies can actually merge together properly. And so therefore, vertical integration is certainly there, and we see lots of examples of vertical integration We see examples where obviously retailers buy some of their suppliers. We also see examples where obviously suppliers buy even the raw materials that are used in that supply process as well. Okay, or for example, in New Zealand, there are a lot of companies in the timber industry in New Zealand, and what they do is they own a lot of timber farms that previously were owned by private owners, but then they've gone out and they've basically just bought them all out to just vertically integrate the actual supply of lumber and trees, so they've actually know they've got that supply always ready to go in the event that obviously there are any price issues that were to come up. Okay, now, pretty sure that's the last one of those facilities. Very good. Now, okay, 904. Very good. Okay, now, if you go onto the LMS, you will see that foreign exchange, obviously, we still need to talk about that. One thing I would like you to do is this, right? And I know you're all busy at the moment doing the assignment and blah, 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 right? But there is one thing that I think you should do, right? We all know what a foreign exchange rate is, don't we? Right? Obviously expressing one currency in terms of another. Okay? Do we know the difference between a direct and indirect quotation? Do we know what it means to talk about a currency as being either a base currency or a quote currency? Do we know what it means to say that a currency is either depreciating or appreciating? Okay? These things are basic things that I would hope all of you have a knowledge about. Okay? So where I'm going to take you with this is this way. On the LMS, there is a short little video that runs for about 7 minutes. Very informative, very, very straightforward video. All right? For me to actually stand and deliver to you what he says to you in 7 minutes will take me about 20 minutes to do. All right? So therefore, I'll tell you lots of stories along the way. So therefore, right, I recommend before the lecture next week, I'll still go through that material, right, but have a look at this video, right, to do with the calculation of, to do with reading foreign exchange rates, I think is the name of the actual video, right. Have a look at it, and it goes for about 7 minutes, okay? Very straightforward, very informative, gives you all the definitions and gives you lots and lots of examples to highlight the issues that he talks about, okay? So if we use that as our base sort of point, then we should be able to then move into some of the more complex things next week, rather than spending the first hour or so just trying to teach you all the basics of foreign exchange, which most of you should already know the basics of foreign exchange anyway. I look around the room here, I think we've all been on a trip somewhere overseas at some point in our life, so I think we all know basically the idea of foreign exchange and how that works, okay? Alright guys, so that might do us for tonight. That always reminds me of a small champagne. Okay guys, thank you all. Thank you also for coming along tonight. I know you're busy with so many things at the moment, but hopefully from some of the things I've said about the assignment might help you with a bit of direction. I can't see you. We're okay. Okay. Okay.
Yeah, I have that. Okay.
last few questions.
Yeah.
What about the executive summary?
Yes.
Counting in the word count? Because it's double stated kind of.
No. If you have a look at the front, I tell you what's in and what's out. In the first 2 or 3 pages,
Okay.
I'll tell you there what's
Yeah,
in.
because I wasn't sure if that was in.
Yeah, I can't remember whether it is. Normally I do include it in the work count. Normally I do include the exec summary in it.
Because we have the executive summary, and then following there's another bullet point saying about we should talk about like a little introduction about the company and everything. It was like double.
No, it's not. They talk about different things. If you have a look at the list of what I've given you of what you need to put in the report, what I tell you got to put in the exec summary is actually slightly different to what goes in the introduction.
Okay, but it's included in the 2,000 words.
That is correct.
Okay.
So you've got to hold about 200 words aside for the exec summary, right?
Yeah, it was like a page. It was
200 pages.
We were kind of uncertain this time. Should we include the operational risk and the financial risks?
It's up to you. We do say financial risk.
It's more like it's more stated like a financial risk, but I don't know how much in depth with the operational risk and then further on. So.
Well, it also says that you've got to identify the major ones, not necessarily like all of them.
Good.
Okay.
Thank you very much.
Cheers. Hello. Did you not go? You were going to head off.
Yeah, hi, teacher. We have problem that in the first part,
Yes.
there is financial ratios, but
Yep.
there are also in the cash flow. This part we also need to analyze the financial ratios.
Why would you be analysing financial ratios here?
This financial ratios, we think it's maybe the same
Where does it say financial ratios here?
ratio, hedge ratio, or maybe analyzes the cash flow. We need to write down some ratio. No, only this part. So we need to more.
When you might, for example, say that the company is exposed to funding risk, right? Because obviously they might have high levels of leverage, and you might demonstrate that by giving me a debt to asset or a debt to equity ratio. Then sure, you would use the ratio there. But when you're doing the analysis parts of this here, you don't need to actually use financial ratios.
Okay.
In fact, I would be surprised if you did.
Okay.
Could you please give some examples about the financial ratio? How to analyze the leverage?
How do you mean in terms of these up here?
This one, yeah.
Okay. Liquidity ratio, leverage, and profitability, right?
Yeah.
So you know what those ratios are, liquidity ratios?
Not exactly.
Okay, you can easily find out, right? Quick search on the internet.
PE ratio.
No, liquidity ratio, like current ratio, quick ratio. Yeah? You're looking at me like you don't know what I'm talking about, right? The ratio to do with efficiency of their activity ratios. No. Okay, so cash liquidity ratios that tell us as to just how much cash the firm has got and the ability of the firm to service its debt and things like that. Okay. Profitability ratios, well, they're obvious ones, right? Return on equity, return on debt, right? Return on assets, etc., right? And leverage ratios, well, there's two primary debt ratios everyone uses, which is debt to assets and also debt to equity. I mean, any basic finance textbook would have this in it.
I think these are the ratios from accounting classes.
Yeah, but finance people use these same ratios.
But we haven't done it using these ratios.
But coming into this class, you've done prerequisite studies in corporate finance. I mean, in some way, I don't teach you how to do WACC either, do I?
Yeah, we have learned the WACC.
Yeah, but you would have done ratio analysis before now as well.
Okay, we will try it. Thank you.
Thank you.
That's all right. Okay. Hello.
Some questions about
Yeah, sure.
The sensitivity analysis regarding the hedge ratio on the jet fuel prices.
Yes.
So our company doesn't really do hedging on the contracts, like they don't go into derivatives, they don't go forward. But
do they have a contract with the supplier to they do some sort of a pass-through or profit share?
Yeah. So do I use that because we analyze like year to year? Do you have some sort of like a ratio? Or do we just...
Well, you can sort of work it out from whatever the arrangements are under the pass-through, which they don't normally tell you a lot about, but you can sort of normally work it out in the sense that is it 100% pass-through? Is it like got a range in it? Has it got a threshold in it that when it gets to a certain level that, you know, the thing doesn't work anymore?
Currently we are doing, because the annual report actually says that like how many volumes?
Yeah, the volume that we use,
the volumes as well as how much was being passed through.
Yes.
So we use that as a gauge. Like,
yeah, that's fine. That's absolutely fine. So what would happen if that changed? What would happen if there was a movement in that, right?
Okay.
What would be the impact in terms of how would that affect their fuel price? And how might that then flow into the free cash flow
as in
as a
the
result?
proportion change of the okay. So I don't need to go and say...
well, you'll never be able to find out details of the actual contract because that would be commercially in confidence.